Hello everyone. I hope I'm live. Okay guys, let's get started. I've just checked that I am live and I hope everything is visible here. So we are going to continue with the topic that we were doing last class, wherein I explained you all that whenever there is an intra-group transaction or an intra-group sale of a non-current asset, you have to adjust for it as if the sale never happened, right? And whatever is the cost of the non-current asset, that shall be adjusted. Whatever is the excess depreciation, that shall be adjusted. And whatever is the adjustment to the non-current asset on the statement of financial position, that shall be dealt with, right? So now, guys, we have understood those three things, provided that I think I gave you an example wherein the parent company was the seller, right? But now, see here, if you all remember, we did this last class wherein we adjusted where the parent company was the seller. So we debit the group retained earnings by 5,000. We credit to the non-current asset by 4,000 and we credit to the net assets of subsidiary, that is working note 2,000, because the subsidiary must have purchased it at a higher price and thus they must have charged higher depreciation. And since they have charged higher depreciation, in order to eliminate that, we will have to add it back to the subsidiary's net assets, right? So this perp will be added back to the subsidiary's net assets of 1,000. The non-current asset shall be reduced by 4,000 because firstly the subsidiary must have purchased it at a higher price. So they must have recognized the asset at a value which is higher than its cost, right? So that adjustment, that 5,000 shall be reduced, which is 5,000 here. But as we all know, that also the depreciation charged on it will be higher. So we have to add back that depreciation because they've reduced it, the non-current asset, by that depreciation value. Right? I'm not going into the depths of it again. I'm just giving a brief explanation of it. Okay. Now, heading on to where the subsidiary company is the set. Right? So, probably, if in case you haven't understood it earlier, maybe you'll understand it right now. So, if the subsidiary company is the seller, that means the subsidiary company is the seller of the non-current asset, right? Maybe the value of the non-current asset without transfer was probably 12,000. Okay. And with transfer, maybe say it was sold for 15,000. That means we have to calculate the perp adjustment here. Now, this is the cost of the asset that has been stated, right? We have to also calculate the depreciation and thus the carrying value of the asset after charging depreciation, right? So technically the value of the asset is 12,000, but it is sold for 15,000. That means 3,000 is the profit that has been earned. That is nothing but 15,000 minus 12,000, which will give me 3,000, correct? Now maybe when it was sold, the useful life was maybe say 5 years. Okay. That means what is the depreciation that we are charging without transfer? It is nothing but 12,000 divided by 5 years. Correct? That is going to be 2,400. I'll just put a negative sign here. Now, for with transfer, I will take the value 15,000, which is the value at which the asset is transferred, divided by its useful life of 5 years at the date of transfer. Correct? And also a negative sign for this because it is depreciation. So that means there is a difference in depreciation of 600. So I'll just state that, right? That means the depreciation is obviously stated as higher, right? Because obviously the asset value stated is high, right? So what is the carrying value? The carrying value does is nothing but 12,000 minus 2,400, which is giving me 9,600, right? So the carrying value without the transfer should have been 9,600. With transfer, it is actually 12,000, and PERP is actually 2,400. That is the difference between the two, right? Now here, subsidiary company is the seller. So the journal entry that we are going to pass is nothing but net assets of subsidiary. Net assets of subsidiary company. Working note 2 will be adjusted. Account debit, right? This will be debited. That means I'm reducing the value from the net assets of subsidiary company. 2 will be the non-current asset, and also 2 will be group retained earnings. Right? So what are going to be the values here? It is going to be nothing but, now since subsidiary company is the seller, subsidiary company obtained a profit of 3,000 because the value to the subsidiary company for this asset was 12,000, but they sold it for 15,000, right? So they earned a profit of 3,000. So I'll just take that 3,000. Then the non-current asset value will be reduced by what amount? So this is in working note 2. This will be on the face of statement of financial position. My asset value will be dropped down, and my asset value will be dropped down by nothing but 2,400. Okay, and my group retained earnings will have a value of 600 as stated here. Okay, why? I'll explain you. So parent company purchased the asset at what value? 15,000, correct? So when we consolidate, maybe the parent company's net non-current asset and also the subsidiary company's non-current asset. The parent company will have stated its non-current asset at 15,000 value, correct? Because they purchased it from the subsidiary company at 15,000. So they will state it at 15,000. But actually it should have been not 15,000. It should have been 12,000, which is the original cost, right? So that means we have to reduce our non-current assets by 3,000, isn't it? We have to reduce our non-current assets by 3,000. But maybe the non-current asset was sold at the start of the year, and we are preparing obviously our financial statements, our consolidated financial statements at the year end. Correct, guys? So that means for the year, if they have purchased it at 15,000, if the parent company has purchased it at 15,000, for the year the parent company might have also charged depreciation on that 15,000. That is nothing but 15,000 divided by 5 years, right? So they must have charged a depreciation of 3,000. But actually, that means they've reduced the value of non-current asset by 3,000, correct? But actually, the value reduced of the non-current asset should have been not of 3,000, it should have been 12,000 divided by 5 years. That is 2,400. That means the reduction in the non-current asset should have been of 2,400 considering the original cost of the asset, right? But the reduction is actually 3,000. That means the parent company has reduced 600 more, right? So that will be added back. Okay. Otherwise, we will be treating it as the value of 15,000 and depreciation on that, right? That is wrong. We have to treat the depreciation of 12,000. We have to treat the depreciation on the value 12,000, right? So 600 will be added back, and thus the net adjustment is going to be nothing but 3,000 is to be reduced and 600 added back, right? So the complete reduction, I'll just state it this as a negative value. So 3,000 is to be a reduction and 600 is to be added back to the non-current assets, and thus the net reduction in the non-current asset that we are supposed to provide is nothing but 2,400, right? Is the reason why this 2,400 is stated. And next one, to group retained earnings is 600, right? So obviously the parent company purchased it at a value 15,000, and thus they charge depreciation of 3,000, right? So the depreciation that should have been charged is 2,400, correct? So that means they've charged excess depreciation of 600 here, right? So that excess depreciation of 600 shall be added back to the group retained earnings, and is the reason why the group retained earnings here are credited by 600. So that is the journal entry. The only differences in both of the journal entries are nothing but the group retained earnings are shifted with the net assets, right? Depending on whoever is the sell. Now, mid-year acquisitions. So in case of mid-year acquisitions for a consolidated statement of financial position, there are not many things to consider, but for a consolidated statement of profit or loss, there is a lot of things to consider. Okay. So firstly, I'll explain you for consolidated statement of financial position. Maybe say the year end of the company, okay, is 31st December. Okay. The year end of the parent company is 31st December. Okay. Now, the subsidiary company's year end, subsidiary company's year end maybe say is, uh, let's take it as, okay, let's not just take the year end of the subsidiary company, but maybe say the year end of the parent company is 31st December. Okay. Now, we have maybe acquired the subsidiary company mid-year. Okay, that means probably we have acquired the subsidiary company on maybe say 1st June. Okay, we have acquired the subsidiary company on 1st June, and the retained earnings of the subsidiary company at maybe say this is for 31st December 2002. Okay, now the retained earnings of subsidiary company are at 2001, that is probably 31st December 2001, the retained earnings of the subsidiary company are maybe say 20,000, right? And for the next year, that is 31st December 2002, the subsidiary company retained earnings have increased by 25,000. Okay, so from 20,000 it has reached to 25,000. That means by the next year, the profit that the subsidiary company has earned is 5,000, right? And this profit earned is nothing but from the date 1st Jan 2001, sorry, 1st Jan 2002 to 31st December 2002, correct? Because it's last year in, I mean 31st December 2001, it was 20,000. That is nothing but the balance at the start of the year for the next year. So from 1st Jan 2002 to 31st December 2002, that is for the year 2002, the profit that they have earned is 5,000, correct? Because the retained earnings balance was 20,000 and now it has increased to 25,000. Now I have acquired the company mid-year, that is on 1st June, maybe say 1st June 2002. Okay, that means from this 5,000 profit, which is for the full year, we assume that the profits accrue evenly throughout the year. Okay, that means we can divide it into 12 months and take 12 months consideration for each month, whatever is the value, right? So maybe say for 12 months, for each month, what is the profit? 5,000 divided by 12 months. It is nothing but 416.67. Okay. Now, we have acquired the company on 1st June 2002. That means from 31st December, or maybe I'll just say 1st Jan 2002 to 1st June 2002. We did not have the subsidiary company with us, right, guys? We did not have the subsidiary company with us from 1st Jan to 1st June. That is January, February, March, April, and May. For 5 months, the subsidiary company was not a part of the group, right? Because we did not acquire the subsidiary company. The subsidiary company got acquired on 1st June 2002, correct? So, from these profits of 5,000, from these profits of 5,000, 5 months profit does not relate to the company, right? So the company will only consider, the group will only consider the post acquisition profits, because before acquiring the company, whatever are the profits, that does not belong to the group or the parent company, right? Only after the acquisition of the subsidiary company, whatever are the profits, that could belong to the parent and the group technically. Okay, so now only the post acquisition profits we'll consider, right? So 5,000 is for the full year, right? Now from this we have acquired the company on 1st June. So how many months of profit will be accrued to us? Will we can receive attributable to us is going to be from 1st June to 31st December. That is June, July, August, September, October, November, and December. 7 months, right? So 5,000 into 7 divided by 12, right? This much of profit belongs to the group, and before that the pre-acquisition profit does not belong to the group, right? That means the pre-acquisition profit is nothing but 5,000 into from 1st Jan to June, right? So January, February, March, April and May. June month will not be considered because it was acquired on 1st June. So into 5 divided by 12. So 2083 is going to be the pre-acquisition profit and post-acquisition is going to be 2916, right? So when we prepare our working note 2 of retained earnings, okay, when we prepare our working note 2, that is nothing but net assets of subsidiary company at acquisition. At that time, guys, we have something that is known as retained earnings in the net assets, correct? Now, those retained earnings at acquisition, what will it be its value, right? At the reporting date, what will it be its value? And lastly, in the post acquisition period, what are the profits that the group has earned, right? So the retained earnings is how much? You can see for the last year, the retained earnings were 20,000, right? So 20,000 is going to be there as a pre-acquisition profit, which is available at acquisition. Plus, we acquired the company on 1st June. So from 1st Jan 2002 to 1st June 2002, whatever are the profits, that is how much? 2083. That is also pre-acquisition profits, correct? That is also pre-acquisition profits. So the total pre-acquisition profits is nothing but 22083. Correct, guys? Because this was the profit at the previous year end, right? 20,000, right? And we acquired the company on 1st Jan 2000. We acquired the company on 1st June 2000. That means the profit from 1st Jan 2002 to 1st June 2002 are pre-acquisition profits, which is obtained by the subsidiary itself. So we do not have an entitlement to it. Correct? So this is going to be my pre-acquisition profits, right? And my total retained earnings at the year end is going to be nothing but 25,000, right? Oops, 25,000 here, right? Because it is stated directly, retained earnings at 31st December 2002 is 25,000, right? So the difference is my post acquisition profit, that is nothing but 25,000 minus 22,083, that is 2916.67, which is the same here. Okay, so we got our post acquisition share of profit either like this or like that, but in the working note too, we are supposed to present it like this. I hope it is clear to everyone, right? Now, that was the only main adjustment that was required to be made if in case there is a post acquisition profit that we sorry, if there is a mid-year acquisition, and this is in consolidated statement of financial position. Also remember your depreciation or finance costs or any other costs which are actually time up, which can be time apportioned, are going to be time apportioned if in case we have acquired the company mid-year, right? We also have a sum on this that we are going to do, so you'll be pretty much clear with it. So these two things will be time apportioned when in case it is applicable, right? So if a parent acquires a subsidiary mid-year, then the net assets of the at the date of acquisition must be calculated based on the net assets at the start of the subsidiary's financial year plus the profits up to the date of acquisition, right? So here also we have done the same. At the start of the subsidiary's financial year, it was 20,000. So we had taken that 20,000, right? You can see here. Plus till the date of acquisition, whatever are the profits, right? So we have acquired on 1st June. So till that date, we had calculated 2083 because 5,000 into 5 by 12, right? So 2083 is the profits that we added, and thus we got the pre-acquisition profits. The post-acquisition was directly mentioned. The difference between the reporting date, retained earnings is directly mentioned. The difference between the two is going to be your post-acquisition profits. To calculate this, it is normally assumed that SS profit after tax accrues evenly over time. However, there may be exceptions to this. The most common one of these is an intra-group loan from parent to the subsidiary at the date of acquisition, right? So the most common one of it being an exception is nothing but an intra-group loan which is given from the parent company to the subsidiary company at the date of acquisition. Now that actually is kind of an exception, because maybe say I have given the loan, maybe say loan has been given. Maybe say the parent company has given a loan to the subsidiary company at 1st Jan. Okay, 2003. And the parent company acquired the subsidiary company mid-year, that is at 1st July. Okay. So as I have told you before, that intra-group loan is going to be eliminated, correct? Intra-group loan is going to be eliminated. Also, if there is any finance cost for one entity, that means for the subsidiary company, they have taken a loan, so they are paying finance cost on it, correct? Maybe say the year end of the company is 31st December. So the subsidiary company is paying the finance cost for it. Maybe say it is 10%. So whatever is the value into 10% into 6 by 12, correct? Because we have acquired the company on 1st July. So July, August, September, October, November, and December, right? It is time apportioned, as I told you, right? And for the parent company who has given the loan, for them it will be an investment income, right? For them it will be an investment income, that is 10% into 6 by 12, right? These two will be cancelled out in the consolidated financial statements because they are an intra-group loan after the subsidiary company has been acquired, correct? But guys, before the subsidiary company was acquired, this loan was given. So before the subsidiary company's acquisition, this loan was still available from 1st Jan to 1st July, correct? So for those 6 months, whatever is the finance cost for one company and whatever is the investment income for another, those will not be cancelled out. Okay, these are not going to be cancelled. Okay, not cancelled, because these were actually taken into consideration before the subsidiary company was acquired. Okay, so I hope this part is clear to you all. Now, heading on further, so in case of mid-year acquisition, if this is the case, the subsidiary will have incurred loan interest in the post-acquisition period that would not have been charged in the pre-acquisition period. So that is what they are explaining, which I have given a brief explanation of. Okay, now this brings us to an end of everything that we were supposed to cover in our consolidated statement of financial position, except for one thing that is pending, which is nothing but these two slides, that is cash or goods in transit. Okay, so what usually happens is, say for example, that there is an intra-group transaction, intra-group sale between the parent and the subsidiary company. Maybe say the parent company has sold goods worth 6,000. Sorry, inventory, I'll just write inventory worth 6,000. Okay, because it is an inventory sale, so I think by this word it will be more clear, right? 6,000 to the subsidiary company, right? On credit, right? So that means the subsidiary company owes $6,000 to parent company, correct? So parent company will recognize a receivable, whereas on the other hand, the subsidiary company will recognize a payable of 6,000 each, right? Now, if guys, these are current accounts, if you all remember, current accounts are to be cancelled on the statement of financial position, right? On the consolidated statement of financial position, the current accounts are to be cancelled out, correct? But if in case the receivable and the payable of the parent and the subsidiary company does not match. For example, the subsidiary company has already paid $5,000 to the parent company, right? But the parent company has still not received it, maybe because of some issues in the bank, or maybe it is a bank holiday, or anything could be the reason, right? Right? So parent company has still not received it. So for parent company, the receivable is still at 6,000, right? But for the subsidiary company, the payable is going to be only 1,000, correct? Because they've already paid 5,000, right? So 5,000, 6,000 minus 5,000 already paid, right? So that means this is known as the cash in transit, right? This is known as cash in transit, right? That means one company has paid it to another, but the other company has not received it, because of which their current accounts are not matching, correct? So if there is cash in transit, okay, then in such a case, what will happen? We will assume that we have already received the cash which is in transit. Okay, so that means technically this cash which has been paid by the subsidiary company, that we have already received. So if for our consolidation, we will assume that we have already received. That means if we have already received it, what is the journal entry we will pass? It is nothing but cash account debit, because we have already received it, so cash is coming in, correct? And two, receivable, right? Because our receivable value will be lowered down, because obviously the receivable was 6,000, out of which 5,000 we have received it, right? So P company, if we are assuming that they have received it, so they will reduce their receivable, right? So it will be nothing but 5,000 and 5,000, correct? So that means now the current accounts between parent company and subsidiary company will match, because this is mainly for the mismatch that is to be settled. Because my receivable for the parent company was 6,000, but the payable for subsidiary company is 1,000. Thus, the mismatch is going to be adjusted here by this adjustment, by this journal entry. So now the parent company's receivable balance, since it has been reduced by 5,000, it will now be 1,000, correct? That is 6,000 minus 5,000 that we are assuming it already to be received. And for the subsidiary company, the payable is already 1,000, correct? So these are the current accounts between subsidiary and parent company. This shall be cancelled out, right? And this adjustment, cash account debit to receivable account, this shall be made on the statement of financial position in the consolidation, right? So you will add it to the cash and reduce 5,000 from the receivable. And whatever is the current accounts of 1,000 remaining, that will be subtracted from the receivable and payable. Okay guys, I hope cash in transit is clear to you all. Also, there is goods in transit. Maybe say parent company has sold goods to subsidiary company worth 5,000. Okay, but the subsidiary company has still not received it. So that means it should be received and it should be added to the inventory. So it should be received, correct? So if it should be received and added to the inventory, so what will we do? We are assuming that goods which are in transit, right? Which the parent company has sold it to the subsidiary, but the subsidiary has not received it. So we will make an adjustment assuming that the inventory is already received, right? So if it is already received, I will debit my inventory, because my inventory value will increase, correct? The goods I have already received it. So then it will be stored in my inventory. That means my inventory is going to be debited. So inventory account debit, right? And two will be what? Inventory, since these goods we have already received, right? So I'll just show you. See, this is the first one, debit cash to receivables. And these goods we have already received, correct? So the journal entry will simply be inventory to payables, right? Inventory to payables, right? That will be 5,000 and 5,000, right? Why payables? Payables is going to be credited because we are assuming now the parent company has sold it to the subsidiary company, right? So the parent company has sold the goods, right? So the parent company will probably recognize a receivable on this, right? Of 5,000. But the subsidiary company has not received these goods yet. So the subsidiary company will not recognize a payable of 5,000, correct? Because as they receive the goods, then they are obliged to pay, correct? So the parent company will recognize a receivable because of the goods in transit, right? But the subsidiary company will not recognize a payable. So in order to recognize that payable of 5,000, I will pass this journal entry as if the goods we have already received. So inventory account debit 5,000 and two payables we have made. So now the payables will be matched with the current accounts 5,000 and 5,000, and this, and then this will be cancelled out. Okay, because this is an intra-group transaction. I hope this is clear to you all. So this was goods in transit and also cash in transit that I've explained here. Okay, now we are done with the consolidated statement of financial position. Let's head on towards the consolidated statement of profit or loss and OC. Right? So now guys, under profit or loss, the basic principle is that from revenue down to profit for the year include all P's income and expenses plus all of S's income and expenses reflecting P's control over S. Like we did for consolidated statement of financial position, we will also have our consolidated statement of profit or loss where we are going to have, just a second. We are also going to have our consolidated P&L, correct? Now, for our consolidated P&L, we will have our revenue, our cost of sales, our gross profit, right? Our gross profit, then again admin expenses, administration expenses, right? Any distribution costs and so on. So all these costs will be mentioned of the parent and of the subsidiary company. So parent company and subsidiary company, correct? Now, the revenue, whatever it is, we have to add them both. Maybe here it is 1,000, here it is 750. Okay, so both of them should be added, correct? That is 1,750. Maybe say the cost of sales is 240 here, maybe the cost of sales is 220 here. So that will also be considered, or maybe 200. I'm just taking random numbers. Okay, and thus the gross profit will be nothing but 1,000 minus 240 is 760, and here it is nothing but 550, and the total will thus be 1310 here, which is the gross profit of the parent and the subsidiary company. Okay, what have I done here? Okay, anyway, yeah, so I just ignore this part. Yeah, so that's it. We have understood that how we are supposed to add. Okay, now that is what simply we are supposed to do. In case of consolidated statement of profit or loss, there are just two working notes that we are supposed to make. Okay, after profit for the year, show split of the profit between amount attributable to the parent shareholders and those attributable to the non-controlling interest. So whatever will be the subsidiary's profit, eventually we'll get the profit, right? Right? That will have the subsidiary's profit and also the consolidated profit, correct? Now, the subsidiary's profit after tax, okay? After tax, or you can say profit for the year, right? Maybe the profit after tax or profit for the year is 1,200, okay? The profit is 1,200. Now, from this 1,200, some part of it belongs to the parent, right? Because the parent has maybe say 80% shareholding in the subsidiary, and the remaining will belong to NCI, that is 20%. So that means whatever is the profit attributable to the parent and the subsidiary, after calculating the complete consolidation, we have to allocate to the NCI and the parent. And for this NCI allocation, we have a separate working note because it is not that simple of a calculation, right? Because you will have any perp or anything adjustments to it will be made, and thus usually we prepare a working note too for it. Working note 1 will be nothing but the simple group structure that we are supposed to prepare every time. Okay. It'll be better if you do prepare that every time. Okay. So that is the basic principle. So now they have provided us information about the non-controlling interest. So let us just have a look at it. Okay. So as I told you, we'll first take the subsidiary's profit after tax, right? So whatever is the subsidiary's profit after tax that will be taken. From this, we are going to subtract any fair value depreciation, right? So guys, what we'll do in the working note 2, I'll explain you. We will have our NCI calculation, correct? So we will take subsidiary companies profit after tax. Okay. Maybe as I have stated earlier on, the profit of the subsidiary company is 1200, right? Now, whole does not belong to NCI. Only it maybe say if the 80% of the company is acquired, 20% belongs to NCI. So I'm not taking 20% of each one of them. I will first make the adjustments to this, and then whatever is the remaining amount of that directly I'll take 20%. Okay. So now guys, if there is any sort of fair value adjustment, okay, like they've mentioned it here, you can see fair value depreciation, correct? So if there is any sort of fair value adjustment and on that there is depreciation, right? So if you remember, when we acquire a subsidiary company, its assets are fair value, correct? So when its assets are fair valued at the date of acquisition, maybe say its book value was 1000, but it got fair value to 1200, right? So we stated as a fair value adjustment in working note 2 if you remember yesterday's class, correct? And then we charge depreciation on it, correct? So whatever is the depreciation charged, that excess depreciation, that also belongs to the NCI, correct? So that shall be deducted, right? So if there is a depreciation maybe say of $30, then in such a case that depreciation shall be deducted, right? The complete depreciation shall be deducted, then 20% of it eventually will be taken. Okay. Then if there is any PERP, right? Only when the subsidiary company is the seller. Okay. Because only when the subsidiary company is the seller, then the PERP will be adjusted in NCI. Okay. Otherwise, it will not be included within NCI. And then PERP, this be it for the non-current assets, sale, or maybe for the sale of the inventory, whatever, wherever you get the PERP, but it shall be provided that the subsidiary company is the seller. Why? Because say for example, the subsidiary company has sold goods or inventory, right? Having a markup or margin, right? Whatever. So if they have sold, then what is the journal entry that we pass for the subsidiary company selling the inventory? Then in such a case, the journal entry that we pass, as you have seen it earlier, I'll just show you that again. Yes. See here guys. So if the subsidiary company is the seller, see this one. Okay, it's here. If the subsidiary company is the seller, what is the journal entry that we pass? We pass debit the subsidiary's retained earnings. That means nothing but the working note 2 is to be debited, right? Working note 2 is to be debited and inventory is to be debited because the inventory is stated at a higher value, correct? So that means it includes the unrealized profit that was not to be actually stated. So here when we are adjusting it in working note 2, it is allocated to the NCI and the group, right? So is the reason why if there is any PERP, only when the subsidiary company is the seller, it shall be deducted from here, be it for the sale of non-current assets or for the inventory. Okay. Then we have what else is pending here? Yeah. If in case there is impairment, right? Goodwill impairment. But that also only if the fair value method is used, right? Because if you remember, only when the fair value method is used, the complete goodwill, even for the goodwill of NCI is calculated, and thus then and only then it shall be allocated to the NCI, right? Otherwise, it is not any which ways allocated to the NCI, so it cannot be stated here, right? But if it is fair value method, yes, it will be stated. Maybe say this is 40, maybe say this is 50. Okay. Then anything else which is pending? So yeah, nothing. So then you get the adjusted profit. So what is the adjusted profit here? It is 1080, and thus you will take the NCI 20% of it. That is going to be nothing but 1080 into 20. right? So 216 is NCI. So maybe say the consolidated profit or loss when you prepare, right? The consolidated profit that you get, maybe say is 600. Okay. So this is the consolidated profit loss you have prepared in which you get the profit of 600, right? So it will be attributable to the NCI and to the group, right? So how much will be allocated to the NCI? 216 we've already calculated. So 216 will be stated here. And to the group will be nothing but the balancing figure, right? So the complete profit is 600, out of which 216 is allocated to NCI and thus 384 will be belonging to the group. So that is how we are supposed to attribute the profit between the NCI and the group after we have calculated the consolidated profit for the year. Okay, so this is how we are supposed to make an adjustment. I mean, this is how we are supposed to calculate the working note too. Okay, now we'll understand intra-group sale and purchase. But before starting with intra-group sale and purchase and its effect on the consolidated statement of profit or loss, we'll just take a break of 10 minutes. Okay, guys, so we'll be returning in 10 minutes. I hope till here it was clear to everyone. If in case any doubts, you can just directly ask me on the live streaming. Hello everyone. I hope we are back. So now let's continue with the remainder topic. So now the first thing that is there in case of your statement of profit or loss is nothing but intra-group trading, sale and purchase. Okay, so the effect of intra-group trading must be eliminated from the consolidated statement of profit or loss. Such trading will be included in the sales revenue of one group entity and the purchaser of another, right? So technically what we are doing is P's revenue plus S's revenue minus intra-group sales, and cost of sales also P's cost of sales plus S's cost of sales minus intra-group sales. Now I'll just explain you what they're trying to mention here. Say that P company sold goods of 10,000 to S company. Okay, so P company will recognize revenue on selling these goods, right? And for the subsidiary company, since it is a purchase, it is going to be in their cost of sales because they purchased these goods, correct, guys? So for one entity, for the parent company, they will recognize revenue because they are selling these goods, but for the subsidiary company, it will recognize cost of sales, right? It will be added to the cost of sales. So when we are consolidating, there will be revenue stated, right? Revenue stated of P company and also of S company, correct? Now, in this complete revenue of P company, maybe say the revenue of P company was 20,000, okay? And the revenue of S company was 12,000, right? In this revenue of P company, 10,000 worth of revenue P company has generated by making an intra-group transaction, by making an intra-group sale of goods. So this shall be eliminated from this 20,000, right? Because in this complete revenue recognized, 10,000 of the revenue they must have recognized because they sold 10,000 worth of goods to subsidiary. So when we are consolidating, okay, when we are consolidating, I'll just mention it here. The consolidated revenue that will be stated will be nothing but 20,000 plus 12,000, right? That is both revenue minus 10,000 of the revenue which is generated because of the intra-group sale made, right? So that will be nothing but 20,000 plus 12,000 minus 10,000, right? So that will be 22,000. Now, for the cost of sales, maybe say the cost of sales of the parent company is 13,000, okay, and the cost of sales of S company is 11,000, okay. Now in this cost of sales included by the S company, there must have been included the purchase made by the S company of 10,000 from the parent company, correct? So that means that 10,000 shall be eliminated from the cost of sales as well, because from these 11,000 worth of goods, maybe say if the if the subsidiary company has purchased from this 10,000 worth of goods they have purchased from the parent company, so that 10,000 shall be eliminated from this as an intra-group sale, correct? So in the cost of sales also, guys, that 10,000 shall be eliminated because it is a cost of sales for the subsidiary company, right? So 13,000 cost of sales plus 11,000 cost of sales, right? Minus 10,000 cost of sales, which is an intra-group sale, okay? Which is a part of the intra-group sale. So it will be 13,000 plus 11,000 minus 10,000. So that will be 14,000, okay? And thus the gross profit that we get eventually is going to be nothing but 22,000 minus cost of sales of 14,000, which is going to be 8,000. Okay. So I hope this part of intra-group sale is clear to you all, how it will be adjusted within the consolidated statement of profit or loss. Okay. Then we have interest. Okay. Now talking about interest. So if there is a loan outstanding between the group entities, The effect of any loan interest received and paid must be eliminated from the consolidated statement of profit or loss. The relevant amount of interest should be deducted from the group investment income and the group finance cost. Okay, so what they're trying to say is that simply I've already explained you this. If maybe say the subsidiary company or the parent company, anyone, maybe say the parent company is giving a loan to subsidiary company, then in such a case, whatever is the interest on it, interest on loan, that will be affecting my statement of profit or loss. In the individual financial statements of P company, this in the individual financial statements of P company, this interest on loan will be stated as an investment income, correct? And in the individual financial statements of S company, this will be stated as a finance cost because P company has given a loan and they are earning interest on it, whereas S company has taken a loan and they are paying interest on it, correct? But in case of consolidation, as I've already explained you, these two will be eliminated. Okay. So that is what interest was explaining. Now talking about dividends. So a payment of dividend by the subsidiary to the parent company will need to be removed from the investment income in the statement of profit or loss because this is an intra-group investment income which has been generated. So the effect of this on the consolidated statement of profit or loss is that any dividend income shown in the consolidated statement of profit or loss must arise from the investments other than those in subsidiaries or associates. Ignore this covered in chapter 14. So this is going to be nothing but any investments which are stated that shall be an investment income only from only the incomes which are generated from the third parties. Okay. So now if the subsidiary company has paid a dividend, okay, subsidiary company has paid, okay, I'll just re-mention this. Yeah. Subsidiary company has paid a total dividend of 1 lakh. Okay. And parent company has acquired 90% of subsidiary company. Okay. That means how much dividend has P company received? P company has thus received a dividend of nothing but 1 lakh into 90%, right? So 90,000 and this will be stated in the investment income of the subsidiary companies, sorry, of the parent company's individual financial statements, right? Because this is the investment made in subsidiary company and they are paying a dividend. So it is a form of investment income in the individual financial statements. But for consolidated financial statements, this is an intra-group income which is generated. Correct. So intra-group income which is generated shall be eliminated. So maybe P company's complete investment income in the consolidated statement of profit or loss maybe is stated as 2 lakh. Okay. 2 lakh is the complete income stated. So from this 2 lakh, 90,000 must be the income which is a part of the dividend received from the subsidiary. Correct. So from this we will subtract 90,000 because that is a part of the income of the parent which is nothing but the payment of dividends made by the subsidiary. So that is eliminated and thus the investment income shall be reduced by that 90,000 ending up at 1,10,000. Okay. So that is what the adjustment for dividends is required. Okay. Note that only dividends paid to the parent company to its own shareholders in the consolidated financial statements. These are shown within the consolidated statement of changes in equity, which you will need to be required, which is actually not required. So what they are trying to say is that when the subsidiary company is paying a dividend, okay, so when the subsidiary company is paying a dividend, maybe in the retained earnings in the statement of changes in equity, in the statement of changes in equity, maybe say the retained earnings of the subsidiary company are stated at 3 lakh. Okay. Then in such a case, from that, the dividend paid by the subsidiary will be completely reduced. That is of 1 lakh, right? Because 1 lakh is the dividend paid. right? So the remaining retained earnings of the subsidiary in the statement of changes in equity will be nothing but 2 lakh, right? But this is an adjustment. These are all the adjustments which are made in statement of changes in equity, correct? And for our syllabus of FR, we do not have statement of changes in equity. Okay, statement of changes in equity is not a part of your FR examination, right? Now, let us understand one practice sum so you will get clarity on the statement of profit or loss, how it is prepared, and what are the components. Okay, the statement of profit or loss for Paddle and Skip for the year ended 31st August 2004 are shown below. Paddle acquired 75% of the ordinary share capital of Skip several years ago. Okay, so that means it is a full year transaction. Now the revenue is stated here, revenue of Paddle and Skip, the cost of sales of Paddle and Skip, and also the expenses, be it the distribution or the administrative, they have been stated together. Okay, then we get our trading profit. Then investment income is stated, which investment income is nothing but a dividend which has been received from the subsidiary company. So obviously, if you remember, dividend which is received from the subsidiary company might be stated as an investment income in the Paddle company's individual financial statements, but while we consolidate, this is to be ignored or eliminated, right? So the profit before tax is thus 243 and 80, but 3 will be subtracted, so these should be 240 and 80, correct? Income tax expense will remain the same and profit for the year will also remain the same. Okay, so everything is just the same. Revenue is just simply added 2400 plus 800, 2160 plus 720, that is 2800. Then we get our profit before tax. As you can see here, investment income is stated nowhere. That $3 of investment income is missing because that is actually eliminated. That is not an actual income which is generated by the Paddle company if consolidated financial statements are considered. Okay. Then we will distribute it amongst the NCI and the parent company. So how will we distribute it amongst the NCI? So you can see the subsidiaries company profit for the year is 40, right? Profit for the year of the subsidiary company's profit is 40 and 75% is acquired by the parent company. So that means NCI is nothing but 25%. So 40 into 25%, and since there are no adjustments to NCI in this, we do not require to prepare a working note separately here. So it will just be 40 into 25%, which is going to give you 10. And to the owner will nothing be but the balancing figure, that is 165 minus 10, which is 155. So I think this was just a basic, very basic sum for you to make it understandable that you know how the statement of profit or loss looks and how it is to be prepared. Okay, so this is a working note prepared for the non-controlling interest. It was actually not required to be prepared because there are no adjustments here, but I just wanted to show you the calculation. Okay, so $40 is the subsidiary's profit, out of which 25% belongs to NCI. So $10 is the NCI value and the balancing figure will go to your group. Okay, now inventory. So that is the intra-group sale that is there. But in which case there is also an unrealized profit. That means maybe say $100 worth of goods are sold for maybe say $120 or $1,000 worth of goods are sold for $1,500. So that means there is an unrealized profit. So how will that unrealized profit be adjusted? So if any goods sold intra-group are included in the closing inventory, their value must be adjusted to the cost of the group, right? The adjustment for the unrealized profit should be shown as an increase to the cost of sales, returning closing inventory back to its true cost and eliminating the unrealized profit. So what they are trying to say is that maybe say parent company sold goods of $8,000 at a markup. Okay, we'll learn markup also here of 20% to the subsidiary company. Okay, subsidiary company has $4,000 worth of goods still in inventory. Okay, the subsidiary company has $4,000 worth of goods still in inventory. Now, parent company sold the goods of $8,000 to subsidiary company having a markup of 20%. So whatever is the cost, that is not right now I'm concerned about. They have just sold it at 8,000 and they have also made an unrealized profit on it of 20%, right? By having a markup of 20%. Okay. Now, from this 8,000, maybe $4,000 worth of goods are sold out by the subsidiary company before the year end, right? And here's the reason why the inventory only has $4,000 worth of goods, right? So $4,000 worth of goods are already sold out, and $4,000 worth of goods are still in the inventory of the subsidiary company. So when we consolidate, right, this concept is same for your P&L and for your statement of financial position, that when the goods are remaining, there is an unrealized profit on it. When we consolidate, we will add the inventory of the subsidiary and the parent company, right? Parent company and also the subsidiary, right? In which case the subsidiary's inventory at the year end, which is pending, it is 4,000, right? So the 4,000 goods which are already sold out, on that there is no unrealized profit, probably because it is sold out to the third parties who are outside the group. Okay, but $4,000 worth of goods are still in the inventory of the subsidiary company, right? So that means when we consolidate, we will add the parent company's inventory and also the subsidiary company's inventory. But this 4,000 includes the profited value which parent company has made, right? So there is an unrealized profit in this value. So we are consolidating the unrealized profit also. So we have to eliminate that unrealized profit here. And how are we going to do that? 8,000 is the value, right? 8,000 is the value at which the parent company has sold it to the subsidiary company. Okay, that means in this 8,000, since it is sold at a markup, in this 8,000, the profit is included, right? Profit is included. That means technically this 8,000 is nothing but the sales value, right? It is nothing but the sales value. So say that if cost, just saying if the cost is actually 100%, okay, if the cost is 100%, then the sales value will be how much? Then the sales value will thus be 120%, correct? Because sales is made up of what? The 100% of the cost of the goods plus the 20% markup on it, correct? So the sales value is 120% and the cost is 100%, correct? So if by this I can say that the sales is 120%, sales value is 120%. So I have to calculate the 20% which is the profit earned on this, correct? I have to calculate the 20% which is the profit earned on this, and that is nothing but the PER, right? Provision on unrealized profit, right? So what is my sales value? I sold it, the goods were sold at a value of 8,000, correct? The goods were sold at a value of 8,000. Right. Out of this, how many goods are remaining? 4,000, correct? So the profit will only be calculated on those goods worth 4,000, right? So here, if 4,000 is 120%, what will be the 20% of it, right? So 4,000, I will just cross multiply into, 4,000 into 20, right? So into 20%, or you can just say 20, divide by 120 into this question mark. So it'll just be 120, correct? So that will be nothing but 4,000 into 20 divided by 120, which will give me 666.67. I'll just take it as 667. So this is the PER that we have calculated. Okay, just reminding again, if in case the cost is 100, but 8,000 is the sales value, they sold it for 8,000, and the sales value obviously includes the cost of 100% plus the profit of the markup that they have given of 20%, right? So this in total is 120. So if 8,000 is 120%, what will be the 20% of it, right? So we are just not taking 8,000. Maybe we can take it as 8,000 also and then divided by 2, whatever is the PER. But we are just taking at 4,000 because that is the value of the inventory which is there, and on that we have to directly calculate the PER. So I think this way it will be better. Okay. So now what will we do? We will take this PER of 667. So now they have sold goods worth 8,000, correct? So when we calculate the consolidated statement of financial position, revenue will be, maybe say for the parent it is 12,000, okay? For the subsidiary company it is 13,000, Okay, from this will be removed firstly the intra-group sales, that is they sold goods worth 8,000. So for one entity it is a revenue, so it shall be removed from the revenue. So it is nothing but 12,000 plus 13,000 minus 8,000. Correct? So the revenue, oops, what is the mistake here? Oh, I've stated 80,000. Yes. So the revenue is nothing but 17,000. Now cost of sales will be what? Cost of sales will be nothing but, say for example that the cost of sales of the parent company is maybe say 9,000. Okay. Plus the cost of sales of the subsidiary company is maybe say 10,000. Okay. And from this also the intra-group sale will be removed of 8,000. Correct? But to this cost of sales, since unrealized profit is there, correct? There is an unrealized profit of 667. So this profit, I have to remove it. So if I have to remove this profit, that means I will add it to the cost of sales 667, right? Because if I add it to my cost of sales of 667, my cost of sales will increase by that amount, and thus my gross profit will reduce by that per amount, right? So then it is adjusted, right? So 667, if I increase my cost of sales by 667, my costs are increased and thus my profit is reduced by that amount, correct? So it will be nothing but 9,000 plus 10,000 minus 8,000 plus 667, right? So our gross profit is nothing but 17,000 minus 11,667, which is going to give us a value of 5,333. Okay, this is our calculation of per within the consolidated statement of profit or loss. Okay. Now, transfer of non-current asset. So, if one group company sells a non-current asset to another group company, the following adjustments are needed in the statement of profit or loss to account for the unrealized profit and the additional depreciation. Any profit or loss arising on the transfer must be removed from the consolidated statement of profit or loss included in the seller's profit. Okay, so whoever is the seller's profit, okay, according to that profit, it shall be eliminated that profit in the consolidated statement of profit or loss. Okay, the depreciation charge for the buyer must be adjusted so that it is based on the cost of the asset to the group, right? So whatever is the excess depreciation charged by the buyer, that shall be adjusted on the whatever is the actual cost and whatever is the actual depreciation on it in the group. Now, let us just look at it. So, if in case the parent company has sold a non-current asset to the subsidiary company, right? The parent company sold non-current asset to subsidiary company with a value, the value of the cost of the asset was maybe say 10,000, okay? But the sale value, that means the value at which it was sold, was maybe say 15,000. Okay, I'm just taking a basic example. So here, whatever is the with transfer, okay, whatever is without transfer, that all we'll state, right? With transfer, without transfer, and lastly the perp adjustment that we are supposed to make. Correct? So firstly, we will have our cost, right? What is going to be the cost here, guys? The cost is going to be nothing but with transfer, it is sold at 15,000, right? So 15,000. Without transfer, the cost is nothing but 10,000. Thus, the perp is going to be 5,000, right? I think you all are getting a bit used to this, hopefully. Then, obviously, your depreciation that is charged, maybe say useful life of 5 years is there, right? So you will divide it 1 divided by 5. You will take 1 divided by 5 as the depreciation. So 15,000 into 1 divided by 5 is going to be my depreciation, right? That is 3,000. Also here, 10,000 into 1 divided by 5 is going to be my depreciation, correct? That is going to be 2,000. So that means the excess depreciation that has been charged is 1,000, right? And thus the carrying value that has been calculated is going to be nothing but with transfer it is 12,000 Without transfer, it is 8,000 and the difference of per is nothing but 4,000. Correct? Now, firstly, what is the adjustment made? We have understood in the consolidated statement of financial position, whatever is the adjustment to be made in the consolidated statement of financial position, correct? But what is the adjustment made to the consolidated statement of profit or loss, correct? So, to the consolidated statement of profit or loss, firstly, the cost of sales that is there, right? That shall be adjusted, right? Because see now, I sold the asset at what value? I sold the asset at 15,000, correct? That means I gained a profit of 5,000, right? As a parent company, I gained a profit of 5,000 as I sold the asset at 15,000, right? So this is my profit. But but I sold the asset for 15,000. So the depreciation that must have been charged to the cost of sales by the subsidiary company because they purchased it at 15,000 is nothing but 15,000 divided by 5 years, right? Depreciation that the subsidiary company has charged is 3,000, correct? So that means actually what should have been the depreciation? It should have been 2,000, right? That is on the cost of asset of 10,000, correct? So the cost of sales might be adjusted by that 1,000, right? So I will have to reduce the profit by 5,000, but also increase the depreciation. I mean, add back the depreciation of 1,000. Okay, that is the difference between the two. Because actual depreciation that should have been charged to us 2,000, but excess depreciation is charged. Okay, so technically I have to reduce profit by this amount and I have to increase profit by this amount, right? Because I am adding it back. So what is the net? The net reduction in the profit is going to be nothing but 5,000 minus 4,000, which will give minus 1,000, which will give me 4,000. So the net reduction in the profit should be 4,000, correct? So it will simply be added to the cost of sales. Okay, so whatever is the revenue that is stated there, okay, in the cost of sales, through the sale of this non-current asset, I have actually earned a profit, the net profit of 4,000. So that shall be reduced from the cost of sales. Okay, so less 4,000 will be done in the cost of sales. I hope this part is clear to you all. I hope there is no doubt regarding it to anyone. Okay. Now we'll just take a break of 5 minutes. So within 5 minutes, we are going to return. Okay. Okay, guys, I hope we are back. Let us continue with the pending portion. So I think within 5-6 slides, our portion is done with, right? Then we'll start solving our sums. Okay. Now, transfer of non-current asset, I hope it is clear to you all. Your cost of sales will directly be reduced by 4,000. Technically, the journal entry that we will pass is nothing but cost of sales account debit, right? It shall be, the charge shall be made, it is an expense, right? So if we are debiting it, we are charging expense to it, right? That means we are adding to the cost of sales the amount of 5,000, correct? It shall technically be reduced by 5,000, right? So you shall reduce profit, that means add to the cost of sales 5,000 to your non-current asset shall be reduced by 1,000 and to again cost of sales of, sorry, your cost of sales is again reduced by what amount? It is reduced by 1,000, correct? So it is added, the expense is added by 5,000 and reduced by 1,000, and thus the net non-current asset credit will be nothing but 4,000. Okay, I hope it is clear. This is an adjustment in the statement of financial position because of the asset, right? This is a debit to your cost of sales, that means you're increasing your cost of sales, right? In statement of profit or loss. And this is a credit to your cost of sales, that means you're reducing your cost of sales in the statement of profit or loss. So the net reduction, net increase in the cost of sales will be nothing but 5,000 minus 1,000, which is 4,000. Technically, it is known as either an increase in the cost of sales, net increase in the cost of sales, or the net reduction in profit that we are supposed to make. Okay, or you can also say net reduction in profit, right? You can call it everything, like both of them, okay? But technically, you just have to simply add it to the cost of sales, this 4,000, okay? And obviously, depending on the seller, it will be adjusted in the group retained earnings or NCI, whatever it is, okay? If in case we are preparing the consolidated statement of financial position, okay? Now, impairment. Once any impairment has been identified during the year, okay? Once an impairment has been identified during the year, the charge for the year will be passed through the consolidated statement of profit or loss. This will usually be through operating expenses, but always follow any instructions from the examiner. If non-controlling interests have been valued at fair value, a portion of impairment expense must be removed from the non-controlling interest share of profit. Okay. So firstly, if there is a goodwill impairment, right? So we state impairment expense account debit, right? To goodwill, right? Going down, because goodwill is credited, it is an asset, it is going down by that value, right? Maybe say the impairment of is of 2,000. So in our PNL, what will be reduced as an expense? In our PNL, we will create impairment expense of goodwill as 2,000, right? And if in case the goodwill is measured at fair value, sorry, that means technically your NCI is measured at fair value. That means it also includes the goodwill. So then in the working note 2 that we prepare, guys, in the working note 2 that we prepare, as I've earlier mentioned, that when you take the profit after tax and after that you make adjustments, you also include the impairment of goodwill there. Okay, of 2,000, and then eventually whatever is the NCI percentage, maybe 20%, you will take that as your calculation in your calculation of the profit attributable to NCI. Okay, so that is the adjustment that you're supposed to make. Okay, so that is what they have explained it here. Both of the points are the same things that I've explained. Now, If a depreciating non-current asset of a subsidiary has been revalued as a part of a fair value exercise when calculating goodwill, this will result in an adjustment to the consolidated statement of profit or loss, and the subsidiary's own statement of profit or loss will include depreciation based on the carrying amount of the asset in the subsidiary's individual statement of financial position. Okay, so what they are trying to state for the other adjustments in fair value. So as we all know that when the subsidiary company is acquired, at that time the assets of the subsidiary company are fair value. So if in case there is a fair value adjustment to it, okay, the adjustment is not stated in the P&L because obviously the assets value is increased or decreased, then in such a case it is stated in the consolidated statement of financial position. But what will be stated in the P&L? The fair value depreciation on this adjustment, correct? The fair value depreciation on this adjustment will be considered and it will usually be charged to the cost of sales. Okay. So this depreciation, maybe the asset value was 100, right? Subsidiary's asset value was 100 carrying value, but its fair value was 120. So that means there is a fair value adjustment of 20, right? And maybe say 1 year depreciation, it had a useful life of 10 years. Okay, a useful life of 10 years. So the depreciation, the fair value depreciation will be nothing but 20 divided by 10 years useful life, that is 2. So this is my fair value depreciation. This depreciation will be added to the cost of sales. Okay, this will be added to the cost of sales, and it will also be reduced in the working note 2, that is calculation of NCI, where we take the subsidiary's profit after tax and then subtract the fair value depreciation. If you remember that working note, it is here. Here, this one. So fair value depreciation, you can see it is subtracted, right? So this fair value depreciation will be added to the cost of sales and subtracted from the non-controlling interest calculation. Okay. That was all about impairment and fair value adjustments. The consolidated statement of profit or loss must include the depreciation charge on the fair value of the asset as included in the statement of financial position. Extra depreciation must thus be calculated and charged to an appropriate cost category, usually to the cost of sales, but in line with the examiner requirement. Here we have charged to the cost of sales because usually the depreciation is charged to the cost of sales. But if the examiner in the question, if it is mentioned that you have to charge it not to the cost of sales but to the administrative expenses, then please do charge all the depreciations to the administrative expenses. Okay. Then mid-year acquisition. Mid-year acquisition for a subsidiary is important, right? Because what happens is whenever we calculate the revenue or the cost of sales, okay, it is for the full year, correct? Maybe say the subsidiary's year starts from 1st Jan 2002 to 31st December 2002. Okay, and maybe say the parent company has acquired the subsidiary company on maybe 1st September. Right? So before 1st September, whatever revenue is generated, whatever cost of sales have been incurred, that was solely entitled to the subsidiary company because that was the operating activities and the profit and loss generated from the operating activities which was done by the subsidiary, right? But on 1st September, the parent company has acquired the subsidiary. So whatever is the revenue of the subsidiary after 1st September, that will be included. Whatever is the cost of sales of the subsidiary after September, that will be included. So say for example, that for the parent company, right? And for the subsidiary company, the revenue, maybe say revenue of the parent company is 20,000, of the subsidiary company is 15,000, right? Then we have the cost of sales of the parent company to be 15,000 maybe, and the subsidiary to be 12,000. Okay. So what will happen here? In the revenue section, while consolidating, the consolidated statement of profit or loss will include 20,000 of the parent company revenue plus 15,000 of the subsidiary company revenue multiplied by 4 divided by 12, right? Because we have acquired the subsidiary company on 1st September. So September, October, November and December. Only for these 4 months, whatever revenue is generated, that will be included in the consolidated statement of profit or loss. Okay. And also same will happen for the cost of sales. It will be nothing but 15,000 plus 12,000 into, sorry, 4 divided by 12. Okay. Oopsie. Into 4 divided by 12. Correct. So thus the consolidated revenue, cost of sales, everything, administration expenses, your distribution costs, your finance costs, whatever is there, everything will be time apportioned. And that is why we always assume here that whatever is the expenses, profits and everything, it accrues evenly throughout the year. It means that nothing but, I'll just write it here, accrues evenly throughout the year. Okay. It means that nothing but, it's not like, in the first month they have the 20,000 is the total profit, or maybe say 15,000 is the total profit here. Okay. So it's not like that, they earned 1,200 in the first month, then the same thing will go on for 12 months, right? They must have earned 1,900 in the first month, then only 700 in the second, then 300 in the third, then suddenly 2,500 in the fourth. So this is not even, but we assume that whatever is the cost of sales and the revenue and everything which is time apportioned, it accrues evenly over the whole year, over the period of months. Okay. So that is the reason why we take 9 by 12 or 8 by 12, assuming that it is even throughout the year. Okay. So this is the mid-year acquisition adjustments that you're supposed to make when you're doing a consolidated statement of profit or loss. So as I said, time apportionment of the results of S in the year 2 acquisition. For this year, unless indicated otherwise, assume that the revenue and expenses accrue evenly. After time apportioning S's results, deduction of the post-acquisition intergroup items as normal. So you're going to do everything else just as normal as before. Okay. So with this, guys, we come to an end of our complete theory chapters, right? It has actually made us understand everything about consolidated statement of profit or loss and consolidated statement of financial position. Now we are going to head on towards our 4 sample questions. But before heading on towards the 4 sample questions, guys, I will have to also show you, which I did not show you yesterday, that is how to get access to the study hub and also how you're supposed to give the examination or actually give a mock paper on the computer based platform, right? Computer based exam platform. So let us just view that first, then we'll take a break and then we'll head on towards the sums that we are supposed to solve. Okay, so let us look at the site that how we are supposed to get access to it. So I hope you all are all clear with the portion, with the chapter. We are just going to solve 2 sums on this today and 2 sums will be solved tomorrow. Okay. So today we are going to solve 2 sums which is based on consolidated statement of financial position and profit or loss, which are difficult sums because it has been taken from the past papers. I have chosen the difficult ones a little bit. Okay. So those 2 we are going to solve, and also then we are going to solve tomorrow a sum on single entity concept, that means individual financial statements preparation, and also on your ratios. Okay. So in total, we will solve 4 sample questions. Okay. Now, let me just show you that how you're supposed to get access to the ACCA study hub and also to the CBE platform. Okay. So firstly, we'll just go to ACCA Global. I will show you how you're supposed to deal with the ACCA CBE platform. So you will just click on this link, ACCA Global, right? And the first site that you see, that is ACCA Global Home. You will click on that. Okay. So you just type ACCA Global and then you will find out this website. As soon as you find it out, you just click on this website. It is nothing but Home ACCA Global. You just click on Students. In the students section, you will get study support resources. Okay. So in the students section, you will get study support resources. You will click on study support resources. Okay. So as soon as you get into study support resources, you have to see ACCA qualification, foundation level or diploma IFRS. we are going to click on ACCA qualification, right? Because we are getting qualified for ACCA, and then we will get the summary of all the subjects that are there for our ACCA qualification. And from that, we have to select our subject, that is nothing but financial reporting. So here it is. Okay, FR financial reporting. We will just click on financial reporting. As soon as we click on financial reporting, this site will open up. Okay, and we will then click on, just go down, go down, go down. You can see here past exams and question practice, right? This one, past exam and question practice. So as soon as you get onto this website, click on past exam and CB platform practice. So you will get past exam and question practice. Then from here, you will log in into the practice platform, right? As you drag it down, you will get this option for logging in into the practice platform. You will click on this small arrow. You can click on the login to practice platform also. You will state your username and your password and just sign in to that. Okay. So as soon as you sign in, you will get your home page wherein you can assign your examinations or everything, whatever you want to study. Okay. It will just take a little bit of time to load. So now, right now it's saying it looks like you don't have exams assigned to you yet, but you have to assign exams to yourself. Okay. So how you're supposed to assign exams? So say I'll just take financial reporting. Okay. Here is financial reporting. As soon as I click on this plus, okay, it will open up ACCA official resources and blank workspace. So we will click on ACCA official resources. Okay. Then we go to past exam library. There it will show you the examinations of the previous years conducted. That is March 21, June 21, right? Your March, June 2022, your March, June 2023, and so on. Okay. But there is also something known as practice sums. So you can click on practice sums. It will give you three full-fledged papers that is going to be helping you practice the examination and get familiarity with it. So we are going to solve this FR pre-September 2023 mock because it is the latest mock that I can see of. So it will be better if we solve the latest mock. Okay. So we are probably going to solve one of these two also. So maybe let me just assign one of them. Okay. So I'll just assign this mock as of now. So it has been assigned. Correct. This mock has been assigned. Now on the left hand side, you can just go down and look for FR past papers, right? So FR past and practice exams. Since I've assigned FR practice exam 2, it has been assigned here and I can just start it. Okay. So as soon as I start it, it will take me to the CB platform, right? So exactly like this, your interface of CB platform is, you can just access your CB platform like this. Okay. And in the examination, when you go to the center or if you're giving a home-based examination, this is exactly how your exam will start. Okay. If you're giving a home-based examination, just take care that firstly, you will not be provided with a pen and paper, right? If you want to note down anything, you will not be provided with a pen and paper. Secondly, you will not be provided with two calculators if you're comfortable using two calculators, because in FR, there is not much scientific calculation. Okay, maybe you need it for the present value calculation, but for your other things like for FM and all, you might need two calculators because maybe you are comfortable with your normal calculator for normal calculation, and only for scientific calculations you need a scientific calculator, right? So two calculators, you can take it at the center, but it is not allowed at the home-based examination. Okay, so that is one. Mainly it also depends on the examiner, that whoever is taking your home-based examination. Okay, so I've told you some important things about home-based examination. Also, it is a bit risky as compared to the center-based, because if there is any issue, they will cancel the examination. If it is a problem from the ACCA side, then in such a case, they might refund you the payment. But if it is a problem from your laptop or from your side, they will not refund you the money and they will cancel the examination. Okay, so just take utmost care if in case you're giving a home-based examination, you have to test your laptop 5-6 times before you give the examination so that it meets all the requirements and the conditions for giving a home-based examination. Okay, I usually prefer telling my students to give a center-based examination because it is very convenient. Okay, so this is how your paper starts. Getting back to the paper, right? You just click on next. They are providing you certain information. You don't need to go through each and every details. But whatever is important, just go through it. Like end exam. Okay, you can end exam when you reach the last question. There you will get the option of ending the examination. So you click next. Then they are giving you options about next, how to go to the next question, how to go to the previous question, then how to flag a question. If in case you're doubtful about some question, you can flag that question, and after completing your paper, maybe you can get back to that question. And if you're not clear, or maybe you have certain things that maybe okay, this might be the answer, so you can select on that, so you can flag that for later on reviewing it. Okay, so you can also highlight a particular question. You can also strike through the question, right? You also have a scratch pad. So in a home-based examination, they don't allow you pen and paper, but in the interface itself, they have a scratch pad where you can state certain things, where you can do your working. Okay. They have a inbuilt calculator as well, right? So you can choose on the calculator and it will help you calculate the answers. But usually you also get your calculators, because it will be better, because then if you have the calculator, if you have the question, if you have the solution to do, it will be too many things on the laptop itself. So it will be better probably if you carry your own calculator as well. Okay, but if you are comfortable with their calculator, it's upon you. Okay, then you have your navigator. From the navigator you will be able to identify that where you're supposed to go, and you just have to click next to all these instructions, right? I think I've covered most of the important instructions that are to be given. So they are also mentioning that how the question will be. Section A will be 15 questions, 2 marks each. Section B will also be 15 questions depending on 3 scenarios, 2 marks each. And section C will be 2 constructed response questions. That means you have to construct your own response there. It is not an MCQ based question. Then you click on next and they will ask you if you're ready to give your exam. Yes. So for reading out all these instructions, you will be given 15 minutes. If in case you complete it in 7 minutes, that doesn't mean you're going to get the 8 minutes for completing the paper. If that 15 minutes you completed in 8 minutes, that 15 minutes goes away. Okay. Then next. Yes. So with this, we start our question, right? So you can see, you can click on the options here. It is not just always MCQs. They might ask you, see, now these are one or couple of 2 of them would be MCQs. Okay. Then there might be certain questions which will ask you directly a dollar value. So here you have to solve it. Okay. It's not like you can, deal with it by yourself or something. You have to solve it, right? You have to just state one answer. So it is not like, by MCQs, by fluke, you can clear the exam. Sometimes they might ask MCQs, in some questions they might not. Okay. So this is your section A. Okay. Your section A has around 15 questions. Then jumping to your section B. Okay. How you're supposed to jump? See, you can click on this right hand side corner. Navigator option is there. So you can click on it. Okay, whichever question you want to jump to. If in case you want to solve question C, you just click on this question. Don't click here. Okay, it'll open. Oh, it has opened now. Okay, usually it used to not open when I used to give the exam. So see, navigator, you can click on just any question that you want to go to, maybe 21st question. Okay, it will not allow you to go to that question if in case you have not scrolled this question completely. Right, so I've scrolled this question down completely also in this slide. Now it will allow me to go to that question, right? So now I can go to that question, whatever I want to solve. Okay. So see now, till first 15 questions, you will be given direct MCQs. You have to just solve them. From 16th question, that is section B, you will be given like this, a full-fledged scenario. And on that, you have to answer 5 questions. See, so this is the first question on it. This is the second question on it. See, the scenario is the same. Okay. This is the second question on it. This is the third question on the same scenario. And like that, there will be fourth and fifth. Now clicking on navigator if you want to flag, right? So firstly, you have flag here. Okay. You have a flag here. So you can flag this for review. Okay. So this question has been flagged for review. Now maybe if I have jumped to question number 24. Okay. I want to get back to the question which has been flagged. So I will just click on navigator and go to that question which has been flagged. So you can see here it is flagged. So I'll just go to that question 18 directly. Okay, and I will jump to that question and resolve it if I've got the answer to it. Okay, here you can see this side you also have your calculator. So you can type your numbers, right? You can adjust the size of the calculator, I guess. Yeah. So this is your size adjustment of the calculator. I don't know if you can minimize or maximize it. I don't think. You can just move it. Okay. So you can move your calculator here, wherever you want. Right. You can state the number 78 into 89. Right. So you can do the calculations like that. So that will give you 694. Okay. If you want to remove the calculator, just I guess how you're supposed to remove it. Yeah. So you get the cancel option on the right hand corner. So you click on that. Okay. You have a scratch pad here. You can type anything on the scratch pad, solve any sums here and do the calculations. Okay. You also have an option to copy and paste with the scratch pad in the scratch pad. So if you have copied something, like say for example, you wanted to copy this part. Okay. Then you don't need to type the whole thing. Okay, plant cost will be this much, this will be this much. You just have to open your scratch pad. I don't know if it will paste. Yes, it did. So it will be pasted like this. Okay. So then you can just head on with it. Okay, this is a sum. Okay, this is the part that I've taken. So it has not been copy pasted clearly. But if I want to copy paste any part from here, then I'll just Control C, right? For copy. Control C will be for copy. And open the scratch pad. Go down. I'll just cut this whole thing. Right? I'll remove this whole thing. So cut. Or I'll just backspace it, and then I'll do Control V for pasting the question, right? So this question will be pasted here. Okay, why has it been not pasted correctly? Okay, let me just check it. Maybe I think I've put the cut option in between is the reason. Okay, I'll just Control C this, and in the scratch pad, I will Control V. Okay, so I'll get the whole scenario. Okay. So this is the use of your scratch pad, of your calculator, of your flag for review, and eventually navigator is there. Go to the last question, that is the 32nd question. Scroll it all the way down. Always remember, if it doesn't let you go to the next question, right? See, if I want to go to the previous question, it is not letting me go to the previous question. Why? Because I've scrolled the left hand side down all the way down, but the right hand side is still pending. Right? So you have to scroll all the way down, then it will let you go to the next or the previous question. Okay. So this is done. Then after that, you will get an option to review all your questions, whatever is complete, incomplete. See, some things which you've unseen, it is stated as unseen. That means I've not even opened this question. Things which are incomplete are stated as incomplete. Okay. And then eventually on the left hand corner, down corner, I will have the option to end the examination, and I will click yes on the end examination. And again, they will ask me a confirmation. So I will click yes for the confirmation. Okay. And lastly, on the left hand side down corner, I have an option to exit. So I'll exit from this platform. It will get me back to the catalog wherein I can choose my another exam to be assigned. Right. And in this examination that I gave, how many marks did I score, be it for the section C questions, for the section A and B MCQ questions, I will just go to mark. Okay, I will go to mark and see here FR past exam papers. In that, see, I will self mark. Now, obviously my marks will be 0 because I have not attempted any question here, right? So I will self mark and it will show me all the solutions, right? So here, this is the interface of the solutions which has been provided to us. Okay, so you can see here question number 1, 2, 3, 4, 5. As you go on clicking next, you will get the solution. So see, the solution is, see, in the right hand side, question sample paper. Click here to see the sample answer. So as you click here, you will see the sample answer. This is the sample answer given to you. Okay. And if you want to see the question, you can see the question stem here. And you can just click on show. So they will show you what is the question asked and what is the answer given. Now here there is not much of an answer provided because obviously it was just a one-liner question, right? Then maybe to the next question where there is a calculation. So as you click on the question, right, you show the question. So you will get the question here and the answer is also provided here, the whole calculation, right? How you got the answer, right? So this is your interface of your solution which is to be checked, right? For your section B and C, right? For your section B and C, how the answer will be provided. So see, this is the complete question stem that you have to calculate the goodwill, you have to prepare the consolidated statement of profit or loss. This is the complete question here, which is provided to you. You can just hide the question now, right? I mean, whatever are the requirements, you can adjust this size, whether you want to see just through the question, right? And then if you want to look at the solution of this question, just you can also download the solution. So for that, under this question sample paper, you have click here to see the sample answer. So you will click here to see the sample answer. So this will give you the sample answer sheet also. You will just press Ctrl S and then it will be downloaded, right? So this thing is downloaded here. I can just save it with whatever name within my tab. Okay. So I can just save it, right? I'll just click on this to show it to you. Right? So this is the solution which is there, right? I'll just save it, right? And I can just save it wherever within my desktop or wherever. Okay? So I can save it like that. For my section C and section C first sum and second sum, this is. Okay? So this is how you're supposed to use your complete interface. I'm just shutting this down. You're supposed to use your complete interface of your CB platform. Okay? Right? This is the whole thing that I've done. You can just click on mark. You can also see your results, how much you've scored, right? I have scored 0 right now. So see my results, FR practice, it is pending. It will be provided within a period of time. Okay. Now, I am explaining you the study hub, how you're supposed to get access to the study hub. Okay. I'll just open another sheet. Okay. So for study hub, I'll just write ACCA study hub directly. Okay. ACCA study hub. I'll click on ACCA study hub. Right. Then I will go down and you can see login via my ACC. Right. Login via my ACCA. So you will click on that. It will take a moment to be loaded. Always remember you've gone at my login to my ACCA. Okay. Then you will go to my qualification. Okay. You will log in. They will give you an option to log in. Right now it's directly logged in. Otherwise they usually give you an option to log in. It will give you my qualification. This is an account of my friend. So I've taken that because we cannot share our personal accounts here. Now in this you can see your ACCA study hub. You click on my qualification. In that you can see ACCA study hub. So you can click on ACCA study hub, and once ACCA study hub is clicked, it will open the whole interface of the ACCA study hub. Okay. Now in this ACCA study hub, you will click, where is it? Yeah. You will click on financial reporting, right? So financial reporting summary is to be given, right? You will go down, you will look for financial reporting. Where is financial reporting? Can't look for something known as financial reporting. SBR, SBL, PM, UK tax, FM. Where did financial reporting go? Yeah, here. It was the first one. How come I missed it? Okay, so you click on financial reporting. So as you click on the financial reporting, it will open up all this for you, right? You have here 4 things. That is firstly the sections. Sections means nothing but whatever are the concepts, whatever are the information, whatever are the details that you're supposed to understand is covered in sections. Then you have flashcards. Flashcards are nothing but a summary of everything which is given. Okay, so if you want to quickly revise all of the things that you've done, you can click on flashcards and you can go through it. Okay, quickly. Then you have practice questions, that those are MCQ questions, or those are full-fledged questions. Everything, every type of practice question is available, right? Though, and lastly, the quizzes that are available for you. So after you complete each and every section, you can solve quizzes on them. Okay, now this is actually quite a lengthy thing to do from ACC Study Hub directly. Like students who are reliable till now on the secondary sources, those are very good sources, like your BBP and Kaplan. You all can still rely on those sources, but ACCA Study Hub also is a very good thing, and since it is a information which is provided by the primary source, it shall be relied upon the most. Okay, it shall be relied upon the most, and is the reason why you can choose to actually study from ACCA Study Hub as well. Those students have already studied till now in for their September attempt from the Kaplan kit, from the BPP kit. Don't worry, no issues. You're still going to cover the same part of the examination. You're still going to be able to cover everything. Okay. But from next examination, if you're comfortable with ACCA Study Hub, you can start off doing your chapters directly from the primary resources that are available. Right. So you can just click on sections. Why is it not clicking here? Yeah. Sorry. You will click on go to exam. Right. As soon as you click on go to exam, this financial reporting thing will start for you. Okay. And in that you have your chapters, flashcards, quizzes, practice. So you are right now in your chapters. Okay. In the left hand side, you can see chapters, flashcards, quizzes. Right. So these are all your chapters and the concepts. So if I click on any chapter, right. So say for example, I have clicked on uh, going concern, for example. So it will show me everything about it. What is your confidence? How much did you understand from it? Maybe I can say medium, I understood from it. Then it will show me the next concept. Maybe I understood high. Maybe I understood low in one of them. So it is going to show me and then test me accordingly that how much I have understood and how much confidence I have with the concept that I've dealt with. Okay. So you can choose like this any concept that you want to understand, right? And then head on towards it. Okay, it has a concept for each and every chapter. Okay, property, plant, and equipment, what could be the accounting treatment, subsequent accounting, everything. Then you jump to your flashcards. So, flashcards will be nothing but what is materiality. They will ask you some things like what is materiality. If you click on it, they will show you information that okay, this is materiality. Then they will ask you, did you get it right? So this is like a question. You have to first answer it, then click on it and check the answer. Okay. So yes, I got it right. Then they will ask you something as prudence. So then you click on it, you will be provided with an answer. Right. Then what is financial statements elements? So what are the elements of financial statements? Statement of profit or loss, statement of other comprehensive income, statement of changes in equity, statement of financial position, right? And your disclosure notes or explanatory notes. Then you click on this and you see, okay, the broad classes of these are nothing but group according to their economic characteristics. Okay, so you can just state yes. Okay, then you have your quizzes. So in your quizzes, you have a quiz on each and every chapter that has been covered. Okay, so maybe you have 5 questions here, 5 questions. I think there are 5 questions in every chapter. So you can solve those quizzes. Then you have big practice exam questions. Okay, so this includes the previous year questions and everything. So you can just directly solve for it from here. And that is as per each and every chapter. So if I want to look for this exam, okay, like lease related questions asked in examination. So see, here is a question given to me for lease. I can actually solve it here. So you can answer the question here. Now this is a one word answer, right? I have to just state the answer directly. If it was a constructive answer, they would have provided me with an Excel or something. Okay. So this is how I'm supposed to get access to my study hub and accordingly solve everything in my study hub. Okay. So I hope you all are clear with the study hub understanding and also this part. Right, guys? I hope it is clear to you all. We'll just take a 10 minutes break now. Probably we'll take a 15 minutes break. So let's have your breakfast also for those who haven't had it yet. So we'll meet. It is 11:15 right now. We'll meet by 11:30. Okay. Thank you, everyone. Hello everyone, I hope we are back. Let us start solving a sum today. Okay. So as I told you that we are done with our consolidated statement of profit or loss. Also, we are done with our consolidated statement of financial position conceptual clarity. We are done understanding how we are supposed to get access to the study hub or be it to the study material or for the center-based examination with a CBE platform. Okay. Now we are going to head towards our first sample question that we are going to be dealing with today. So today we'll be doing one sample question and tomorrow we'll be doing the remaining three sample questions. Day after tomorrow, one more, and the day after that will be one more. And that is how we have planned to complete our whole revision session. Okay. So today we'll be doing one question that is from the section C, that is nothing but Laurel Company. Okay, I'll just maybe maximize the size. Okay, I think this is too much. I'll keep it at 130%. Okay, yeah. So now let us understand this question and then accordingly solve it. Okay, guys. Now, on 1st January 2006, Laurel acquired 60% of the equity share capital of Rakewood in the share exchange, in which Laurel issued 3 new shares for every 5 shares acquired in Rakewood. The share issue has not yet been recorded by Laurel. Additionally, on 31st December 2006, that is after a year, okay, I mean by the year end, Laurel will pay to the shareholders of Rakewood $1.62 per share acquired. Laurel's cost of capital is stated as 8% per annum. So as you can see here, guys, there is a share exchange. Also, there is a deferred consideration, which we have done it in the statement of financial position. Correct? If you all remember, it was nothing but your deferred consideration wherein you calculate the present value and include it in the cost of investment, and also your share exchange. Through the share exchange, how much you're paying, right? And for that also, they must have given certain information. Yes, here. At the date of acquisition, shares in Laurel and Redwood had a market value of $7 and $2 each, respectively. That means Laurel's share value is $7, whereas Redwood's share value is $2. Parents is 7, subsidiary is $2. Okay. Now, they've given us, they've given us the statement of profit or loss, and they've given us certain information for equity separately. Okay. That means the equity section of our statement of financial position. Okay. So in this, they've stated the equity shares of the subsidiary company, right? And the parent company, the retained earnings of the subsidiary company and the parent company, right? They've given us the following information. The following information is relevant for all of these adjustments, right? And eventually what is required? Required is calculate the consolidated goodwill at the date of acquisition of Redwood Company. Also prepare the consolidated statement of profit or loss for Laurel Company for the year ended 30th September 2006. Okay. So for this statement of profit or loss preparation, guys, I'll just increase the size a little bit. Okay. I'll keep it at 60. I don't know how much it will be visible. Okay, so technically you should prepare your working notes on the right hand side, and or maybe below your statement of profit or loss or statement of financial position, whatever you intend to prepare. But guys, I am preparing here right in the face because right hand side my face is there, so I cannot prepare it there, and I don't want to scroll it down so much. So I'll just prepare here firstly the working notes, and then below that I'll prepare the consolidated statement of profit or loss. But in examination, please keep in mind, firstly prepare the statement of profit or loss or financial position, whatever is required, and then below that show the working notes, or besides that on the right hand side show the working notes, whatever is convenient for you. So sorry guys. Okay. So now let us prepare the first working note, that is nothing but group structure. Right? So for your group structure, who is the parent company? The parent company is Laurel Company, and they have acquired the subsidiary company, that is Rakewood. Okay. So Laurel Company has acquired Rakewood company. Okay. And for how much percentage they've acquired? They've acquired 60% of the company on 1st January 2006. Okay. So you mentioned the percentage of the company acquired and the date of acquisition is nothing but 1st January 2006. Okay. This is the working note that you can show. You can show it otherwise like however you want to present it. Okay. I am stating it like this here. Okay. Then comes the working note 2 that we will prepare. What they've asked in question is that, as I told you, that in your exam, this is a past paper, okay? In your exam, when they will ask you to present a statement of profit or loss, the consolidated statement of profit or loss, it is quite short, okay? So they will not, throw marks 20 for this, okay? So they will usually ask you something for goodwill, for the calculation of goodwill as they've asked here. Okay, so you have to calculate goodwill separately. Okay, so you have to calculate goodwill also here with your statement of profit or loss. Then and only then they will give you some marks will be for example 6 marks probably will be for the goodwill and maybe 14 marks will be for the consolidated statement of profit or loss being prepared. Okay, that could be the allocation of the marks. Now I'll just state that working note 2 that I'm preparing goodwill. Okay, because any which ways the first thing that we saw is nothing but the cost of investment that we have, right? So firstly, in the cost of investment, the initial para that is there, what is it? Laurel has acquired 60% of the equity share capital of Recwood in a share exchange in which Laurel has issued 3 new shares for every 5 shares it has acquired in Recwood. That means Laurel has paid 3 shares for acquiring 5 shares of Recwood, right? So they have paid 3 shares for acquiring 5 shares of Recwood, and it is not a share exchange, it is a share exchange of the number of shares acquired, right? They have stated 5 shares it acquired in Recwood. So that means first we have to identify what are the number of shares acquired, right? They have acquired 60% of the shares, right? So firstly we'll see what is the share capital. So you can see equity share capital at 1st October 2005 is 15,000, correct? Of the subsidiary company it is 15,000. That means the share capital, okay, share exchange is nothing but what is the share capital? It is 15,000, right? Into you have acquired 60% of it, into you gave up 2 shares for acquiring 3 shares, correct? That is only the scenario, right? In a share for share exchange, sorry, 3 shares for every 5 shares, right? So it will be 3 by 5, correct? 3 divided by 5 shares, correct? This is the share exchange. The shares that you give, that will be the numerator. The shares that you get in the share exchange, that is going to be the denominator. And it will be multiplied by the market value of the parent company's share. Okay. Each share market value of the parent company is stated here at $7. So we will take that because the parent company is paying. So how much parent company is paying? Maybe the parent company is paying 15,000 into 60% shares, right? In 15,000 into 60%, right? If for example the parent company was paying 2 shares, okay, right, and each share value had $7. So how much cash is the parent company paying in the form of shares? It is nothing but $7 per share into 2 shares, right? $14. So you take it with the market value to identify how much amount is paid. Okay, so the market value is $7. We've taken it as $7. So the share exchange is nothing but 15,000 into 60 divided by 100, or you can say 60%, into 3 divided by 5 into $7, right? So that will be 37,800. Okay, I hope it is clear till here, everyone. Now we'll understand deferred consideration. Okay, I'll just write the short form def con. Okay, you don't do that in examination, please. Okay, now before moving on to the deferred consideration, you can see here you have to prepare the statement of profit or loss for the year ended 30th September 2006. But when have you acquired the company? You have acquired the company on 1st January 2006, correct? So that means January, February, March, April, May, June, July, August, September. you have done a mid-year acquisition of the company. Okay, so I just mentioned here this is a mid-year acquisition, and everything that is to be sorted, it is to be sorted for 9 months. Okay, so this is a mid-year acquisition and you have to calculate for 9 months. Okay, so now deferred consideration is how much? As you can see here, guys, in this para, what have they stated? That the share issue has not yet been recorded by Laurel. Additionally, on 31st December 2006, that means by the year end. Okay, not by the year end, but they have acquired on 1st January after 12 months. Okay, that is by 31st December 2006. Laurel will pay to the shareholders. Laurel will pay to the shareholders of Rakewood $1.62 per share acquired, and Laurel has a cost of capital of 8%. So if you remember, what do we do in deferred consideration? Laurel will pay 15,000 into 60%, right? Firstly, because Laurel is going to pay how much? $1.62 for each share acquired, right? So the total shares of the subsidiary is 15,000 and you have acquired 60%. So for each share acquired, they are going to pay $1.62, correct? Oops. $1.62 they are going to pay for each share acquired, right, guys? And this is going to be multiplied by 1 divided by 1.08, right? I'll just mention this calculation. What am I doing? Okay, I'll just do this calculation again to show you because I don't have space here. I'll do it here. Is equal to 15,000 into 60% into 3 divided by 5 into $7, correct? So this is 37,800 and this will be, why 1 divided by 1.08? It is a future value, right? In the future, I will have to pay 15,000 into 60% into 1.62, right? What is that? 15,000 into 60% into 1.62. That is going to be 14,580, right? Technically, how much do I have to pay? I have to pay 15,000 into 60%, right, into 1.62. This is the total amount that I'm supposed to pay at 31st December 2006. That means after 12 months. Okay, I have to calculate the present value of it. So what is the present value formula? 1 divided by 1 plus R raised to N, right? Right? So I'll multiply 14,580 in by this formula, right? And for this, they've given me a percentage of 8%, right? They've given me, see here, you can see that the Laurel's cost of capital is 8% per annum. So I'll take that. So 1 divided by R is nothing but the interest rate, that is 8% per annum. 1 plus R is 8%. So that means 0.08, right? And I have to present value it by how many years? By just 1 year, correct? By 12 months. So I will just state 1. So raised to 1 is like nothing, right? So it is just nothing but 1 divided by 1 plus 0.08 is 1.08, correct? So raised to 1 is nothing. Even if I don't state it, it doesn't make a difference. So that is what I've done here. Okay, and thus the calculation for deferred consideration will be 15,000 into 60%, right, into 1.62 divided by, into 1 divided by 1.08, right? So that will give me a value 13,500. Always remember 13,500 is the present value, or the, you can say, the fair value of the deferred consideration, but the actual amount that is to be paid is 14,580. Okay, actual amount that is to be paid is nothing but 14,580. Okay, now we are done with this much part of the goodwill, that is cost of investment. Now we look for NCI, right? NCI mostly will be at fair value, right? Because they, how do I get to know about it? Because see, they've given the share price of the NCI of the subsidiary company as well. So from that you can assume that mostly it will be fair value, but we look at the adjustment. So yes, look at second adjustment. Laurel's policy is to value the non-controlling interest at fair value at the date of acquisition. For this purpose, Rakewood's share price at 1st January 2006 can be deemed to be non-controlling interest. Fair value will be calculated as nothing but equity shares of the subsidiary company, that 15,000, right? So it will be nothing but 15,000, correct? And what is the NCI percentage? We have acquired 60% of the company. So 40% belongs to the NCI. That means 40% of this total equity share is the NCI share value, right? And how do you calculate share value? How do you calculate NCI at fair value? It is nothing but the shares that NCI owns multiplied by the share value of the subsidiary company. Okay. So as you can see in the question, the fair value of the subsidiary company is mentioned as $2, right? You can see here it is $2. Right? So I'll just simply calculate this amount. That is going to be nothing but 15,000 into 40% into $2, right? So that will give me NCI at fair value, which is nothing but 12,000. Okay. I hope this part is clear to you all, right? Now I'll just state net assets at acquisition, right? The net assets of subsidiary at acquisition, right? Now I have to calculate net assets of subsidiary at acquisition. So I'm not preparing the whole working note again for that. Okay. I'll just show you. I'm just preparing a separate working note, but I'm not doing the post acquisition, the reporting date and all that for it. We'll just directly solve values. Okay. So working note 3 I'm preparing for your net assets of subsidiary company at acquisition. I'm doing it only for at acquisition. Okay. So firstly, obviously you have the share capital, this is which is already mentioned, right? The share capital is nothing but where did the share capital go? 15,000, right? Where is it? Where is it? Yeah, this 15,000 is the share capital which is mentioned here, correct? Now, okay, I'll just not do that. I'll directly mention 15,000. Okay. So share capital here, guys, is mentioned as 15,000. Then you will obviously have the retained earnings of the subsidiary as well, correct? Now, what are the retained earnings of subsidiary? The retained earnings of subsidiary are 25,000. Right? This is when on 1st October 2005. That means on 1st October 2005, I'll just increase this size also. Yes. So, okay, I should lower this. I think 16 is sufficient, right? Yeah. So at 1st October 2005, what are the retained earnings? They are 25,000, right? But we acquired the company when? We acquired the company on 1st Jan 2006, correct? We have acquired the company when? On 1st January 2006. So we have to firstly identify the profit for the year, right? What is the profit for the year of the subsidiary company? See, record company profit for the year is 10,400, correct? Okay. At 1st October, it was 25,000, correct? To this, for pre-acquisition, the 3 months will also be November and December, right? Because after this, on 1st January it was acquired. So after that it will have post acquisition, right? And pre-acquisition is what? 25,000 plus the first 3 months, that is October, November and December, where the subsidiary company was not acquired, right? So I'll just do 10,400, which is the profit for the full year. That is from 1st October 2005 to 30th September 2006. Okay. So 10,400 into 3 divided by 12, right? So 2,600 is for those 3 months, and thus till the date of acquisition, the total profit, the pre-acquisition profit or retained earnings, you can say, is nothing but 27,600. Right? So at acquisition, the retained earnings are nothing but 27,600. And you are just showing if you want to calculate the post-acquisition retained earnings, it will be nothing but the whole 25,000 is the retained earnings till date plus 10,400, which is the retained earnings for the full year. Correct? Which is the profit for the full year. So 25,000 plus the profit for the year. This will be your retained earnings at at the reporting date of the company, right? So we have got our retained earnings at acquisition. Then is there anything else? So let us look at the adjustments if in case there are any adjustments to be made. Yes, look at the first adjustment, guys. At the date of acquisition, Laurel conducted a fair value exercise of Redwood's net assets, which were equal to their carrying amounts with the following exceptions. That means these were not equal to their carrying amounts. An item of plant had a fair value of $4 million above its carrying amount. At the date of acquisition, it had a remaining useful life of 2 years, right? That means fair value adjustment is there, right? And for that plant, right? For that plant, fair value adjustment is there and the fair value has increased by 4,000. So the net assets at acquisition has increased by 4,000, correct? For that fair value adjustment. If in case there was a fair value depreciation, it will be charged post acquisition, but we are not calculating post acquisition because we are not preparing statement of financial position. I don't want you all doing unnecessary work because you have a limitation on the time when you're completing the exam. Okay. So only do what is required to be done. Okay. So fair value depreciation we are not doing here because any which ways we have to identify only at acquisition, right? Also there was inventory which was fair valued, right? You can see here inventory of 800,000 had a fair value of 1 million. All of this inventory has been sold by 30th September 2006. That means by the reporting date, all of this inventory has been sold. But its fair value has increased at the date of acquisition, correct? Because it is written at the date of acquisition, the inventory value was $800,000, which has increased to 1 million, right? That means there is a 200,000 increase. So fair value adjustment for the inventory also will be stated, right? 200,000, which is nothing but 200, correct? So this will bring you the inventory increase and eventually it is sold out, right? So when it is sold out at the year end, it becomes nil. But what it is that once your inventory is sold, where is it going? It will go to your cost of sales, correct? Once your inventory is sold, the related cost will go to cost of sales, correct? So this 200 will also be added to the cost of sales. Don't forget that, right? These kind of adjustments actually create a problem while tallying or while calculating the actual answer of statement of profit or loss. These small adjustments always create a problem, right? So these kind of things don't strike to most of the students, right? So is the reason why please keep one thing in mind, that your intention in your examination is not to complete the whole thing or know each and every journal entry and waste 1.5 hour on a same sum. Don't do that. How much ever you know, you do that. After that, if you're guessing a particular adjustment, make that particular adjustment, okay? Because it is not possible for each and every student to actually tally the whole thing, but you can tally the whole thing. It's not like you cannot, right? You have the brains. If you have the skills, if you have the hard work with you, you can do it. For this, guys, it's not like probably either you have the brains, right? Or secondly, like you have the brains to think outside the box, or secondly you've solved all the sums of the exam pattern, so you know all the concepts. So that is your hard work which will pay off when you solve this up in examination. Okay, so I think that is it. I don't think there is any other adjustment affecting my net assets of subsidiary at acquisition. I've done this, I've done this, I've done the third one. Third one is perp. So that is not affecting at acquisition, right? And here dividend is there, a dividend is there again. Assume except whether indicated otherwise. Okay. So no, there is no other adjustments to my working note 3, that is net assets of subsidiary at acquisition. So I'll just calculate the total, right? So the total will be nothing but 46,800, right guys? So we are done with working note 3 also, which is required, that is 46,800. Okay. Now we'll prepare one more working note 4, that is for our PERP. Okay. For our PERP we are supposed to prepare, because I see one adjustment for PERP. This one. Okay. Laurel had traded with Redwood for many years before the acquisition. So they have been trading for a long while. Sales from Redwood to Laurel. Okay. So that means subsidiary company is the seller. Throughout the year ended 30th September 2006 were consistently 1.2 million per month. They always try to trick you here. Okay. Don't take 1.2 million as the total amount. 1.2 million is for the per month, right? 1.2 million is for per month. That means if per month is 1.2 million and this is a mid-year acquisition, don't even multiply it with 12, right? So per month is 1.2 million. So it will be multiplied by 9, right? Because 9 months are there. till the year end after you've acquired the subsidiary company. So this is the total value that has been traded, correct? So this shall be reduced from the revenue and from the cost of sales. Don't forget that, right? Because for one company it is a revenue, for the other company it is a cost of sales because they've purchased it, right? So don't forget that part. Now we'll just calculate perp here. So 1.2 million per month, or you can just say 1,200 per month. What is happening? Yeah, 1,200 per month. So for the 9 months, it will be 1,200 into 9 months, which is going to give you 10,800, right? This is my intra-group sale, right? Now you have to first see that how many of these goods are still remaining in the inventory of the parent company, right? Always mentioned here, subsidiary company is the seller, right? So 10,800 is the total sale of goods between the subsidiary and the parent company, right? Out of which, where did that go? Yeah, this one. Out of which there is a markup on cost of 20% on these sales. Laurel had 1.8 million of these goods in inventory as at 30th September 2006. So please keep in mind there's a markup of 20% and the goods which are remaining in the parent company's inventory is 1.8 million because the parent company has purchased it. So it will remain in the parent company's inventory because subsidiary is the seller. Okay. So 1.8 million, that is nothing but inventory remaining at the year end is nothing but 1,800, which is nothing but 1.8 million. So PERP will be calculated as 1,800. This is the sale value, right? Because this is a markup. Markup means nothing but it includes the sale value. Okay. For, clarifying yourself, whatever is the amount stated, 12,000. Okay. If they stated that this 12,000 is markup, okay, that means this is cost, right? Cost may be of 100% plus whatever is the profit. This is that whole amount, right? So this is complete 120%, right? And if they've stated margin, right, and they've stated 12,000 including a margin of 20%, then this is not 120%, this is just 100%, and on this you will calculate the margin. Okay, that means for markup, now in this case what will we do? 1,800, that means this include the sale value, that means this is 100% of the cost plus also the 20% of the markup, right? So this is 120%. If 1,800 is 120%, what will be the 20%, right? That is what we are supposed to calculate here, correct guys? So that will be nothing but 1,800, we just cross multiply 1,800 into 20 divided by 120, correct? So this is our PERP, that is 300. Okay, are you all clear guys? We did not reduce this PERP in the working note to net assets because this is adjusted in the post acquisition profits and we have not considered that anyway. Okay, so this is your PERP. Now anything else pending? Okay, your PERP is adjusted. Now any adjustment pending? So we've done these two adjustments, right? Your non-controlling interest is also calculated. Your PERP is also calculated. Yes. Now this part. So Laurel's investment income consists of its share of dividend of $5 lakh paid by Recwood Company in August 2006. Okay. So that means in August 2006, Recwood paid a $5 lakh dividend to the parent company, and that is what probably stated in the investment income. So where is the investment income? Look for the investment income. See here. Investment income 500,000, same 5 lakh. Laurel Company, whatever dividend subsidiary has paid, that Laurel Company has stated it as an investment income in their individual financial statements. So this will be eliminated, correct? This $500,000 is going to be eliminated. I'll keep it red, right? Because it is to be not stated, right? So this will be eliminated in the consolidated statement of profit or loss. Okay. Then a dividend of $2,000, okay, $200,000 has been received, okay, from Arctic Company, a 25% owned associate, which it has held for several years. The profit after tax of Arctic for the year ended 30th September 2006 is 4 million, right? So the profit after tax is what? 2.4 million. So that means if the profit after tax is 2.4 million, that is 2,500. How much is the dividend that we have received? A dividend of $200,000 is received. So that $200,000 is never recognized. It is not recognized. We will just recognize the share of profit in associate. So that will be nothing but 2,400 into the share of profit in associate, that is 25%, right? So what will be the value here? That is going to be 600. So we always remember, never recognize the dividend, but we do recognize the share profit of associate. So they have stated that the profit for the year is 2.4 million. We get the 25% holding we have in the associate. So we get the 25% of it. Okay, that is nothing but 600. But always remember, the dividend paid by the associate is also never stated. Okay, only the profit that we get from it will be stated, right? Then these adjustments are done with, right? Then assume, except where indicated otherwise, that all the items of income and expenses accrue evenly throughout the year. Okay, and there were no impairment losses within the group during the year ended 30th September 2006. Okay, so we do not have to charge any impairment to goodwill. But I think I forgot one thing to do, that is nothing but unwinding. Okay, so I'll do the unwinding this side. I hope it will be visible for you all. Oops. Right, we'll do the unwinding here, guys. So for our unwinding, it is very simple, right? We just have to calculate that how we are supposed to charge the finance cost, correct? So as you remember, we've done it in the previous class also. When we were doing the consolidated statement of financial position, I mean yesterday's class, we did the unwinding, right? So our present value is nothing but of this deferred consideration. The present value is nothing but 13,500, correct? The present value is 13,500. But as I told you, what is the amount that is supposed to be paid? It is 14,580. That means we have taken it from 14,580 to 13,500 using the 8% interest, right? Again, we have to pay eventually 14,580. So we have to take it from 13,500 to 14,580, and that process is known as nothing but unwinding. Okay, and we will do it using the 8% interest rate, which is specified. So it will be nothing but finance cost account debit to deferred consideration account credit, right? So your value will be nothing but 13,500 into 8%. Always remember, into 9 by 12, right? Into 9 by 12, because the subsidiary has been acquired mid-year, right? So only 9 months of finance cost after that I've acquired, that will be charged. The remaining 3 months, that will be in the next year, right? So 810 is the value of the finance cost. Okay guys, 810 is the value of the finance cost. So I'm not doing another adjustment for unwinding. I've just specified here on the goodwill side, unwinding. I've done the net assets of acquisition at acquisition of the subsidiary. I've done the PERP calculation. I think we have completed all the adjustments which are necessary to be done, right? Now we'll just prepare our statement of profit or loss. Okay, so let's get started with the preparation of statement of profit or loss. Okay, so while starting off with the preparation of statement of profit or loss, the thing that you're supposed to mention as the head, consolidated statement of profit or loss for the year ended 30th September 2006, right? So you have to state this full line. They can cut your marks, and even if you just mention this line, they might give you a mark or something, okay, while solving the sum. But that should not happen, guys. Don't just write this line. Please solve the whole sum, okay? So now the first thing that is there when you prepare your statement of profit or loss is nothing but the revenue that you state, correct? Oops. Right? So what is the revenue? The revenue of the parent is nothing but, you can say 84,500 plus 52,000, right? 84,500 plus 52,000, but always remember into 9 divided by 12, right? because we have acquired the company mid-year, right? And minus the intra-group sale. What is the intra-group sale? We had calculated it in POP, we will find it, right? That is nothing but 1800. See, sorry, 10,800, right? Intra-group sale, you can see here it is 10,800. So this will be the value of the revenue, and thus what is the value of the revenue, guys? It is nothing but 52,000 into 9 divided by 12 plus 84,500 minus 10,800, right? So our revenue will be nothing but 1,12,700, right? This is our revenue, 1,12,700. Also, always guys, please mention this dollars, because it is always in millions, but we are stating it in thousands. Okay, so please mention it like this, that whatever are the values, they are in dollars. Okay, I mean $1,000, right? Now, after the revenue, we have our cost of sales. Now, for this cost of sales, it will be better if we just make, okay, we'll not make it. Working I wanted to make because I think there were too many components to it. Let's just make a working for it. Okay, I'm making a working below. Okay, I also have to make a working for NCI notes, correct? So this is working note 5. That is nothing but cost of sales, correct? So we will first add P's cost of sales, right? Then we will add subsidiary company's cost of sales. Then any intra-group sale will be deducted, right? Then any POP will be added back, right? Any fair value depreciation is there, for example, right? Fair value depreciation is to be charged, right? Because it will go to your profit or loss, correct? Then any fair value adjustment of my inventory, right? Inventory, as I told you, that it is added to the cost of sales because it is sold by the year end. So once the inventory is sold, it is going to your cost of sales, correct? So that adjustment is to be made here. Fair value depreciation is of the plant, not of the inventory, guys. Inventory is not depreciated. Okay. So P's cost of sales is how much? P's is 58,200 and Rakewood Companies is 34,000, right? So 58,200 and 34,000. Right, I'll just do it here. 58,200 and also 34,000. The intra-group sale was nothing but 10,800, that I'll deduct. The POP that we calculated was, I guess, 300, right? Yeah, POP is calculated as 300. So that will be added to the cost of sales, right? And fair value depreciation of the plant will be how much? Now, the plant fair value was 4,000, correct? As you can see here, if this adjustment here, an item of plant had a fair value of 4 million above its carrying amount, and at the date of acquisition, it had a remaining useful life of 2 years, right? That means you're depreciating it using 2 years, correct? So it will be nothing but 4,000 divided by 2 years of depreciation. Always remember, into 9 divided by 12. Depreciation is charged only for 9 months because after that, at the date of acquisition, the fair value depreciation came into existence, right? So since then only 9 months has passed by the reporting date, right? So it will be nothing but 4,000 divided by 2 years into 9 divided by 12, right? So I'll just put a negative sign here because it is a depreciation, sorry, not a negative, because depreciation is added to the cost of sales, right? Oops, so what is the mistake here? Okay, how did I do the sum here? Okay, I'll just do 4,000 divided by 2 years into 9 divided by 12, right? So 1,500 is the fair value depreciation of the plant, which is to be charged to the cost of sales, right? An inventory of 200 is to be added here, and thus my cost of sales total will be nothing but consolidated cost of sales total is going to be 83,400, right? It is going to be 83,400. Okay. Is there a mistake somewhere? 58,200. Okay, yes, I'm so sorry, guys. I just took 34,000 total. Don't make this mistake like me. It is 34,000 into 9 divided by 12, correct? right? So this will be 25,500, right? The cost of sales, not complete cost of sales, are to be stated. Like I did it for revenue, just because I did not mention it here, I forgot to just put 9 by 12. But always remember it is going to be 9 by 12 here. Okay. So your cost of sales is going to be nothing but 74,900. I'll just write here cost of sales, right? Which is prepared in working note 5, right? And the value that I'll equal to here is nothing but 74,009. Okay, so my cost of sales is mentioned. I'll just put it as a negative amount. Yeah. So my gross profit that I got is nothing but 37,800. Right? This is my gross profit. Now, the distribution costs, the administrative expenses, right? Then I think you will get profit from operation after that, correct? Right? Profit from operation. So let us look at these values. Distribution cost is how much, guys? 2000 plus 1600, right? 1600 into 9 by 12. Don't forget that, please, because I forgot it once. Yeah. So 2000 plus 1600 into 9 divided by 12, right? So the value will be nothing but 2000 plus 1600 into 9 divided by 12, right? So it will be minus 3200. Same thing for administrative expenses. There is no impairment, so I don't think there is any other adjustment to administrative expenses. 4,100, 100 and 2,800 into 9 by 12, correct? So 4,100 plus, how much was it? 4,100 and, yeah, 4,100 and 2,800, right? So 4,100 plus 2,800 into 9 divided by 12, correct? So 4,100 plus 2,800 into 9 divided by 12, right? So this is going to be my administrative expenses, and thus the profit from operation that I get, oops, is nothing but 37,800 minus 3,200 minus 6,200. That is going to be nothing but 28,400. Correct, guys? Now we have our investment income, right? And below that will also be stated something which is known as income from associate, right? Whatever income we generate from associate. So that we have already calculated, right? Associate had a profit for the year of 2,400 and we own 25% on it. So 25% will be the profit, correct? So 2,400 into 25 divided by 100, that will give us a value of 600, right? For investment income also, guys, one thing was pending. Yes, investment income of the parent is to be eliminated because that is a dividend paid by the subsidiary. Intra-group dividend is to be eliminated. Investment income of the subsidiary is to be added, correct? Investment income of the subsidiary is to be added, and that will be nothing but, oopsie, yes, of the subsidiary will be nothing but 400, don't forget, into 9 divided by 12, right? So what is the investment income here? It is nothing but 400 into 9 divided by, that will give me 300, correct? Then we have our finance cost also, correct, guys? So what is the finance cost? The finance cost is nothing but, firstly, where is it? Yeah, finance cost. It is 300 here, but it is nil for the subsidiary company, right? So finance cost will be nothing but 300 of the parent, 300 of the parent. Don't you think are we missing something? The deferred consideration finance cost of 810, correct? In the unwinding, we do it 810 deferred cost, deferred consideration finance cost, right? So that shall also be added to the finance cost, that is 810, right? So our complete finance cost will be nothing but 300 plus 810, right? So our complete finance cost is 1110, and thus we get from this our profit before tax to be equal to nothing but 28,400 plus 300 plus 600 minus 1,110. That is 2819. Right? Now we'll charge the tax expense. So the tax expense is how much, guys? You can see your income tax expense 4,800 and 3,600. So 4,800 plus 3,600 into 9 divided by 12. Correct? Because our profit is of 9 months, the tax on it will also be of those 9 months profit only, right? So 4,800 plus 3,600 into 9 divided by 12, right? So that will be 7,500. I'll just put these as negative signs. So you will get it in negative, right? And thus you get the profit for the year, or you can say profit after tax, whatever, right? Which is going to be nothing but 2690. Okay, guys, this is the profit for the year. Now there is one thing which is pending here, that is how much will be attributable to NCI and how much to the parent or the group, right? So working note 6, which is the last working note that I'm preparing for NCI, right? So firstly we'll take the profit after tax of the subsidiary company, right? So what is the profit after tax of the subsidiary company? Yes, it is 10,400, right? But it is not going to be just 10,400. It will be 10,400 into 9 divided by 12. Don't ever forget this. Okay? 10,400 into 9 divided by 12. Less the following adjustments will be made. That is nothing but fair value depreciation. Correct? Fair value depreciation. Any perp will be adjusted. Why? Because see, this working note, perp, who is the seller? Subsidiary company is the seller, right? Subsidiary company is the seller, and thus it will be reduced from the NCI as well. Okay. Otherwise, if the parent was the seller, you will not adjust it in NCI. Please keep that in mind. Okay. So what is the perp? It is nothing but 300, right? I'll just put equal to sign and take the value directly from that column, right? This is 300, right? So the perp is 300, right? It will be a negative sign because it is reducing my profit. The fair value depreciation is also how much, guys? Of the plant, huh? We had calculated it somewhere, right? Okay, anyway, I'll just recalculate it. So the value of the plant was 4,000, right? Into 9 divided by 12, divide by 2 years depreciation, right? Into 9 divided by 12, right? So you will get your fair value depreciation of 1,500, right, guys? So this is accumulated. Then also the fair value adjustment of the inventory, right? Fair value adjustment of the inventory, don't forget, because obviously as the inventory is sold, it is stated in the cost of sales, and also the inventory is a part of the subsidiaries fair valued assets, right? So that will be reduced here, as it is reducing your profit because it is sold, right? At the year end, that inventory is sold out. So the fair value adjustment is deducted from here. Okay, because you don't have it anymore, right? So it will be nothing but 7,800 minus 1,500 minus 300. Sorry, I'll not put minus. I'll just do 7,800 minus 1,500 minus 300 minus 200, right? So the profit, adjusted profit, is nothing but 5,800 and we will take the NCI. How much is the NCI percentage? 40%, correct? So NCI 40% here. So 5,800 into 40% of the adjusted profit, we will get 2320, which is to be allocated to the NCI, right? And thus profit for the year is 2690. We will just take profit attributable to the following, that is nothing but NCI and the group, right? Group will be nothing but the balancing figure, right? So to the NCI, how much is it? To the NCI, as we calculated in working note 6, it is nothing but, where is our NCI? 2320, right? So NCI is 2320 and this is just the balancing figure. That means from the total profit for the year, I will subtract the profit attributable to the NCI, that is 2320. So I will get the profit which is attributable to the group, right? So this is how we prepare the complete statement of profit or loss, wherein we have a complete number of adjustments regarding the perp, regarding the fair valuation. Only there could be, things like these, like this inventory, where you would be like, okay, how am I supposed to adjust this? So that could make a confusion, right? That could make a confusion. And this could affect a lot of things, right? Because see, your net assets of subsidiary at acquisition is affected if you do not adjust it properly here, right? Then also your NCI is adjusted, right? And if this is adjusted, obviously your goodwill amount will go wrong. So always keep in mind, these are minute changes. These are minute outside the box questions or adjustments which are asked, which you should know. Otherwise, you can actually, create a problem there. Okay, so it will be better if you are not, if you're smart, if you're hardworking, you will obviously clear and you'll obviously score 20 on 20 in this, right? But if you're in not any one of those, at least focus on the other side where you are good at, right? So with this, we are done with the consolidated statement of profit or loss. We've understood a sample question here. Now, today we are ending up the session early. Tomorrow, because our portion is completed for the day early, right? So tomorrow, that is going to be on Monday, we will have the remaining 3 sample questions being done, because today the full sample question will not be done, right? On Tuesday, we will be doing 1 mock paper, right? And on Wednesday, that is the last day of the revision class, we will be doing another mock paper, right? That is mock paper 2. So we will solve over the period. We have understood the ACCA study hub with the center-based examination, how to understand the interface. We have completed 1 sample question today. Monday we'll complete the remaining 3 sample questions, and mock paper 1 and mock paper 2 will be done on Tuesday and Wednesday respectively. Okay, so for today this much is enough. We are going to end the session here. We meet in the next live streaming out on YouTube for your FR revision class with IIC Lakshya. Thank you so much, guys. We meet in the next class. Bye bye.